according to Fannie Mae, because you may not care about what interest rates are, but you might care what borrowing costs are for either a house or a car. Kelly Evans.
You absolutely do. Real quickly, there is a standout in the markets today. Don't lose this one. GE Vernova is up 15% pretty much to a record intraday high. The best stock in the S&P, shares have more than doubled this year. The company issued strong guidance at its investor meeting. That'll do it. Key to that guidance, Brian, multi-year demand for electricity from some of the world's biggest tech companies. This is one of my favorite stories. We don't have time right now, but the GE spinouts and how well they've done. Vernova, which was supposed to be a wind company, now is doing as well as it is fascinating.
Well, turbines, all the money is in turbines. You want to power that through a pipeline, through a natural gas power. I love that everybody is something now interested in energy. All right, let's get right now our all-star Fed panel. Set you up not just for today's decision, but also the markets and meetings ahead in January, March, and April. Very pleased, as always, to be joined here in studio. David Kelly of JP Morgan Chase, Francis Donald of RBC Capital Markets, Jim Karen of Morgan Stanley joining us remote. Jim, welcome as well. Francis, I'll start with you. Your expectations for today.
They're going to cut, but I got to tell you, today is not about this Fed decision for me. It's about what it continues to reflect about an incredibly complicated economy. We have very limited data visibility. We know that employment is softer, inflation is rising, the economy is fragmented into that K-shape we all know about now. And let's not forget, we have a once in 100-year trade shock. How is the Fed going to explain all of this to us? And how are they going to set us up for 2026 in an economy that is decreasingly interest rate sensitive and yet still has its firm eyes on what Powell or Powell's predecessor does next?
Would you consider David Kelly today to be what they would say is a hawkish cut, but with cautious language?
It's kind of like when parents give a kid, okay, you can have one more cookie, but this is the last cookie.
It never works until the next one.
No, well, exactly. But I think there's going to be it's going to be a cut. We could get multiple dissents here, and I think they're going to really push it out and say, don't expect another near-term cut.
Jim, I don't want to look too far ahead of today because it does matter. 90% chance of a Fed rate cut today. Looking at the CME Fed Watch tool, you got about a 25% chance in the market of a rate cut at the January 28 meeting, first one of next year. Where do you land on the next possible cut?
So on the next possible cut, it's going to be all dependent on what happens in the labor market. The labor market is really the key messaging for the Fed. The Fed has to be careful, though, right? It doesn't want to walk into a policy mistake by being either too hawkish or too dovish. Because the path of least resistance right now is towards higher bond yields, which is not necessarily effective or a good thing for markets. So if the labor data continues to weaken, if it softens further, then I think January is very much on the table. If it doesn't, then we're going to kick the can down the road.
Yeah, we're going to find out here in about 15 seconds. Like we said, it is a mixed trade. You got the NASDAQ slightly down, the Dow slightly higher, the 10-year yield right around 4.16%. Let's go now to Steve Leisman on the Fed's decision on interest rates. Steve.
The Federal Reserve reducing interest rates by an expected quarter point to a new range of 3.5 to 3.75. There were 3 dissents. The first time that's happened since September 2019. 2 were against the cut, including Chicago Fed President Austin Goolsbee, along with Kansas City Fed President Jeff Smith, his second dissent in a row. Also, another dissent for a 50 basis point cut from new Fed governor on loan from the administration, Stephen Myron. To recap, the vote was 9 for cutting a quarter, 2 against cutting, 1 for cutting 50 basis points. The Fed signaled a higher bar for the next cut, using language that it's used in the past to do so, saying that it will assess incoming data to determine the extent and timing of future rate moves. That language it used it last December to signal a pause. The rate outlook suggests consensus for just 1 more cut next year and 1 more in 2027. But as I'll get to when I talk about the dot plot, a lot of disagreement. Before the dot plot, though, I want to talk about some pretty big news when it comes to the balance sheet. The committee making a determination, it is now at what it calls an ample level of reserves. So it plans to initiate purchases of shorter-term treasuries on an ongoing basis. And then a separate document was specific, saying the Fed will begin buying $40 billion in bills starting December 12th. That's just a couple days from now. And I believe that's sooner than the market expected. And those purchases will go on for a little while at an elevated level because of seasonal demands for reserves that are out there before coming down again in April. That's what the document says. Outlook on the economy in the statement. GDP outlook was stronger next year in the Fed's own forecast, up a half a point to 2.4%. So pretty big move there in the outlook for GDP next year. The inflation outlook lower for next year by just a tick, down to 2.5%, just about hitting the target of 2.1 in 2027. The statement says the economy is expanding at a moderate pace, job gains have slowed, and unemployment has edged up. Just a note, the statement no longer says that the unemployment rate is low at the current rate. Inflation is seen as somewhat elevated, economic uncertainty also elevated. Back to the Fed outlook and the dot plot real quickly here. Only 2 dissents, but 6 officials in total wanted no change in the funds rate according to the dot plot. So kind of a soft dissent in that regard, you can call it. 7 want no change at all for next year. 11 only want 1 cut next year. One person, and we can imagine who that is, Stephen Myron, just guessing here, wants rates down to 2.12% next year, or 150 basis points lower. And that is the statement and the outlook for rate cuts and the balance sheet. Mr. Sullivan.
Quickly, sir, you said buying bills maybe sooner than the market expected. This is not QE. I do not dare call it that. But is this like the son of QE, quantitative easing light?
You know, Brian, people are going to take off on this, and I don't want to stop the craziness that'll happen in social media and on the interweb. The Fed will say this is maintenance of its balance sheet at a level of GDP of where it was. Some people, however, will call it QE light. Some people will call it son of QE. I believe the Fed will say this is neither, that this is simply maintaining the balance sheet at what they call the ample level of reserves, and that will cause them or prompt them to begin buying $40 billion of bills. It looks like 3 years. They also may go out a little bit into the bond market as well, but they want to stick to the short end of $40 billion a month until about April, when they say there'll be a sharp decline in there. And Brian, call it what you will.
Let's see what Rick Santelli calls it. Steve, stay right there as you continue to dig through this. The market reaction initially showed a very dovish tilt. We have stocks moving to session highs. We have bond yields falling. Rick, your interpretation?
Well, my interpretation, Steve nailed it. I don't disagree with social media going hog wild. They could put any spin on it they want. Ample reserves to deal with the reverse repo market issues, but it is QE, call it QE light. And once again, I have an issue with this, and my issue is simple. Every crisis, they expand the balance sheet by buying securities to manage rates or manipulate rates. Pick any M word you want. But in the end, this is something to really pay attention to. And finally, the markets themselves, we saw a couple of basis point drop pretty much across the whole curve, 358 down to 356 in a 2-year. 10s were hovering right around that 416 level. They dropped about 2 basis points to 13 and change. They're right back to 415. What's notable is where we were this morning, as Brian pointed out, the fact that we're toying with 420. Remember, we closed at 457 last year. We're getting ever close to unchanged on the year, on a year that many analysts and experts thought we'd be spending a boatload of time under 4%. We've had a total of 8 sessions close under 4% so far in 2025. The dollar index, no surprise there. It's down about 1/3 of a cent. It was down about 1/4 of a cent before the statement was read. It's definitely toying with this 98 3/4 to 99 level. It seems to have lost its hunt for 100 recently, but that makes sense considering the Fed's easing. And finally, the next meeting, January. Many are talking about the January 28th meeting. For a while today, we had about a 30% probability of a 1/4 point ease. That's now moved to around 24%. It's been bouncing around a bit. If you look at the March 18th meeting, that's also hovering around a 25% probability of a 1/4 point cut. But basically, the real issue for 2026 is how much the market's going to pull out on the easing mentality as we continue to get data that certainly doesn't look like the labor market is dying a quick death. And with in terms of inflation, not a lot's changed in the last 16 months. It's sticky, and it doesn't seem to be coming down closer to the Fed's target.
Rick, appreciate it, and we'll circle back in a moment. But let's get more from Mike Santoli. Mike, on what jumps out to you about the market's reaction here and what the Fed just told us.
Yeah, sort of net positive. I wouldn't say it's a real vociferous reaction. Obviously, it's during the press conference that we sometimes get more of the swings or the rethink or the unwind of the unwind. We know the drill on Fed days. But there has been a value over growth, cyclical stocks over defensive stocks, financials leading, especially banks. That has meant that the market has been kind of revving in this direction of anticipating a firmer economic performance in the early part of next year. We could be proven wrong on that, but the market seems pretty resolute in trying that hand. And I don't think that today's cut and going on hold because we weren't priced for further cuts in the coming months is necessarily enough of a surprise to disturb that in any respect. I mean, the Fed was on hold from December of last year till September of this year, and we had other things moving the markets around, but it was not really a rates issue. So the longer term coming in a little bit in yield, maybe that does loosen things up a little bit, although I wasn't particularly alarmed at the level that long-term yields had gotten to in this run.
All right, Michael Santilli. Michael, thank you very much. All right, let's go back now to our panel. We got Jim, Francis, and David. Francis, I want to go to you because let's talk about the job market, and I'm going to compare the last meeting minutes, and you'll forgive me, I got to look down and read it. Here's what they said at the last meeting minutes about the job market. They said the unemployment rate is edged up, but remained low through August. So they said, oh, okay, it's edged up, but it's low. This year, first paragraph, the unemployment rate has edged up through September, hard stop. So they seem to be acknowledging that the job market has weakened a little bit. I guess that changes the odds of a potential rate cut.
I like your word a little bit, because if you look at a chart of the unemployment rate going back to the 1970s, it's only been this low 2 times over that period, Brian. So I'm wondering why this is suddenly not low, particularly that we've only seen what I would consider a normalization in the labor market. In particular, this hasn't been broad-based across all age groups. It's been really focused on young individuals in the United States. So is this really a labor market that's quickly deteriorating? It doesn't look much like that much feared hockey shape movement to me. Meanwhile, inflation has been above target for 55 months. So if I was looking at the bulk of the data and I looked at that dot plot and I looked at the Fed's forecast today, I would be saying, oh, they must have decided to hold or hike in that type of environment. What I want to hear from Powell during this press conference is, how the heck did you convince this committee to end with a cut today?
David, did they convince it? We had 3 dissents.
Well, no, and it sounded like we could have had 6
More.
dissents. 6
They
dissents.
dissented on what they call the dot plots, which I hate that term. It's like the Fed's light bright, where they put in where they expect rates to be. 6 non-moves on that, 3 actual dissents. So 3 people, I'm sorry, I'm going to say this, 3 people chickened out. Well, they wouldn't go on the paper and say, I disagree.
Well, exactly. And you can see that from the language in some of the speeches that we saw after the last Fed meeting, which actually convinced markets they weren't going to cut today, because some of particularly the regional bank presidents are really hesitant to cut, at least in what they say. But then when it comes to it, they give the kid another cookie. And actually, it's a slightly bigger cookie than expected, because they got this extra liquidity for the short end. But I do think this is more dovish short term, but still pretty hawkish long term, because if Steve's reading of this is right, they've upped their estimate of GDP growth next year by a lot. We've got all these income tax refunds that are going to kick in the first half of next year. That's going to push growth higher, regardless of what the jobs market is doing right now. And it sounds like there are very few members of the Federal Open Market Committee who want to do more than 1 rate cut next year. And if you're only going to do 1 rate cut in the year, when are you going to do it? Maybe you wait all the way until December. So we're going to have it's going to be interesting here with the Fed perhaps going on pause in the first half of next year.
All of that said, maybe we can put this on the screen. The tech ETF, we were talking about this yesterday on a 12-day win streak. Well, it's now in the green after this move up to possibly have a 13-day stretch that would be its longest in about 8 years. So that's meaningful. We also have silver and gold on the positive and on the rise. Jim Karen, I was just going to bring you in on this, because it seems, and I think John Spallanzani's phrase captures this perfectly, that he calls it, says the repo vigilantes won. Because the big headline for a lot of people, even those who are more bearish on bonds, is the Fed's back, they're buying, and they're doing so. Maybe it's just bills, but it's significant that this action is now coming a little bit more quickly than people thought. What does it tell you?
Hi, Kelly. Listen, I think that's a great way to frame this. On balance, this to me is a more dovish meeting. Now, yes, it is true. And I would really say that this is ironic, right? And I think we have to see the irony in this. The Fed has basically raised the bar for the next rate cut, right? So we still think they're going to cut, but it's going to be a higher hurdle for them to do that. However, they did surprise the market on the dovish side by moving that balance sheet management from what many people thought was going to be early next year to actually what's going to happen starting right now here in December. The Fed is basically telling us that they want to have pro-cyclical policy, I mean, they want to support the growth cycle. They're going to stand at the ready to cut interest rates if the labor market deteriorates further. And at the same time, they're worried about liquidity. They want to add liquidity back to markets. Call that reserves, call it what you will. The point, though, is that we need to get over the year-end turn, right? So liquidity constraints might come in at the end of the year. And the Fed wants to avoid that type of a stress in the marketplace. So net, the fact that they're willing to start to inject this liquidity, worry about reserves, and that's a lot of what's going to maintain, I think, some of the bullish sentiment in the markets, which is what we're seeing reflected, is actually the net dovish component, even though they raise the bar for the next rate cut. So I think it's a bit ironic.
Well, also, Jim, back to you, because a lot of people are listening or watching at home going, all right, this is great. What do I do? Well, to Kelly's point, the NASDAQ ticked up, the XLK on pace for its 13th straight day of gains. That would, I think, tie for an all-time record, or at least going back the 8 years. Why did stocks move up if prospects for more rate cuts went down?
Yeah. So effectively, one of the big concerns that was in the marketplace was that the Fed would have very inflationary policy, that they would be dovish and that they would push these long end rates higher because whoever the next Fed chair is, could potentially cut rates a lot. What the Fed is telling us right now is that they're not willing to do that. So what that's doing is it's stabilizing the back end of the yield curve. It's allowing the equity markets now to say, oh, we don't maybe have to worry so much about this inflation impetus that might come out of a Fed that's too dovish. So again, ironic. And that is actually something that's very supportive for the equity markets if rates stay relatively stable and well contained.
Yeah. And Steve, you want to jump in here?
Yeah, I wanted to back up what Jim was saying about the dovishness of the balance sheet decision. We asked in our Fed survey, which we released yesterday, about the balance sheet expectations, and it was for purchases to begin again in April. So this is quite a bit earlier, and for purchases to average just about 28 or 30 billion. So this is more than that. So on that front, for sure, I would also point out that when I'm looking at the immediate reaction of the market, it's a little bit more dovish in terms of that next rate cut. We had it more fully priced in for June before the statement came out, and now it's about a 57, 58% probability for April. That's going to bounce around. And all of that said, this entire discussion, I would point out, may go out the window next week when we get October and November employment numbers, as well as some inflation numbers, and we'll figure out if the Fed made the right call here and whether or not the forecast is worth either the paper that was used to print it or the digital space it's taking up on the web.
That's an excellent point. As always, Steve Leisman. Francis, the Fed has two mandates. I mean, people forget about that. We always talk about inflation because of what happened during COVID and prices spiked and inflation was 9%, blah, blah, blah. But they also have the jobs mandate, maximize employment. How do we read the jobs part of the picture vis-a-vis what the Fed may or may not do?
I've been thinking a lot about this because I keep wondering to myself, how can you be cutting interest rates when inflation is this high and per our forecast going to be heading higher? In fact, it's really hard to see when that next cut is going to come through. I have to agree with David here. When is the window to do that? Because by February, we see that inflation side moving higher. And yet, Brian, this is not interest rate driven inflation. This is tariff level inflation. This is inflation that is coming from a labor market that is shrinking, immigration, retirements that are coming through. And part of me wonders if this Federal Reserve is saying our interest rate policy is far less relevant to the inflation side of the picture than it is to the job side.
Okay, let me follow up with that. Do we ignore, I hate to say this, do we ignore inflation? If exogenous factors, tariffs, whatever, are contributing, labor costs during COVID, whatever, if they're contributing to inflation and there's nothing the Fed can realistically do about it, should they cut rates anymore at all?
Well,
why not raise rates?
Here's the rub here. The problem is if they don't actually contain inflation, it can spiral out of control. So you start with tariff level inflation, you start with some wage pressures that sort of create a floor underneath. If you don't respond to it properly, if you're too easy, then that can start to spiral. But there's another elephant in the room here, which is that we have phenomenal amounts of fiscal spending. And how funny it is to me that we spend so much time attributing monetary policy to inflation, and we forget that expansionary fiscal policy is also very inflationary. So the forces on inflation are wide-ranging and shouldn't just go to the Federal Reserve policy. So it's not a surprise to me that their bias is towards the labor side of the mandate.
Well, I think the other part that we're not talking about is just how high the equity market has been. I mean, this is the end of 3 booming years for the equity market. And I personally don't think the Fed ought to be cutting aggressively or at all right now, but it's not because of what they're going to do to inflation. Or
So you would have dissented. You would have. You would not have cut.
I would have dissented, and I would have voted the way I did with what I said, because the problem is that they have caused asset bubbles over the years by keeping rates at an unrealistically low level. And I think the danger is they're just going to cause another asset bubble. And when these bubbles burst, they cause tremendous damage. So there's nothing wrong with a federal funds rate at 3.75% to 4%. I think that's okay. The economy should be able to do.
The president would disagree because people want mortgage rates to go down to 5%.
Well, the mortgage rates, long-term mortgage rates are determined by the 10-year, not short-term rates. And if you scare people about inflation, or indeed if you cause a booming stock market, that actually will probably help keep those long rates higher. So I don't think. Anyway, why do we have a housing problem? It's not because mortgage rates are too high now. It's because the mortgage rates were way too low for a decade, and that caused prices to spiral out of to a level that people can't afford.
Who kept them low? Who kept them?
Well, the Federal Reserve.
There you go.
No, exactly.
Thank you.
That's exactly my point. The Federal Reserve should aim for a relatively neutral level of interest rates, and honestly, that's where we are right now.
I'm going to paraphrase Animal House. You screwed up. You trusted us. David Kelly, Francis Donald, Jim Karen, Steve Leisman, thank you all very much. All right, let's get another check of the bond market because, Rick, as David just adroitly pointed out, the bond market is going to determine rates, not the Fed.
Well, quantitative easing would argue with you. The market can only do so much if the Fed starts pulling out securities from the marketplace, affecting supply and demand. It does make a difference. Now, to that end, the yield curve is steepened a couple of basis points. Now, I understand many out there are saying, well, a couple of basis points, but it is significant how it's doing it. So a 2-year note right now is almost exactly 2 basis points lower than before the statement. The 10-year is exactly the same. Arguably, the yield's a little bit higher. So we've touched 60 basis points in the 2-10 spread. And I think that is something to pay attention to. It doesn't surprise me that the shorter maturities are looking at this in a more dovish way than the long end, because the long end has not only to try to distinguish between what's going on with the economy and the Fed, but it also has to keep an eye on things like debt issuance and just total debt around the globe. We did postpone today's 22 billion 30-year bond auction because of the Fed meeting. We'll have that tomorrow, but I think it'll be very interesting to see how that demand goes. And then finally, Steve Leisman pointed to some of the percentages and probabilities in Fed fund futures. And I always put a word of caution that these things are just markets. They change moment to moment. But the next meeting that even is close to the possibility of an ease, anything over 50%, that would be the June 17th meeting at the moment. Back to you.
All right, Rick, we really appreciate it. And I think it's a good point to make that as this kind of settles in for the past 20 minutes, markets are looking a little bit more on the bond side like they were pre-decision, although equities are still near session highs. Let's talk more about that now with Jeff Kilberg. He's the founder and CEO of KKM Financial. What do you say, sir? Welcome.
Well, Kelly, kind of a surprise. Everyone was looking for a cut in rates, more hawkish, and we actually got more. If you think about that, $40 billion they're going to start purchasing in just a couple of days. That's annualized $500 billion of new QE. So with a $6.5 trillion balance sheet, I think a lot of folks were surprised. That was the initial reaction in equities, but you're seeing a little bit of a shift here, and we're waiting for the presser. But I think this was much more dovish, and I think Fed Chairman Powell is keeping his job for another month because that's the one that we haven't talked about yet. And I think the long end of the curve is not pricing the fact that he may not be here in May of 2026 if President Trump has his way.
So right when the decision came out, you were standing right there, and you
Yes.
heard me say, this is the son of QE,
Yes.
or QE light. Because to me, that's the headline. That's why stocks are moving. It's not the interest rate. No offense to any of our headlines or whatever. It's this diet QE
In the
with
immediate,
T-bills.
the sense of urgency. December 12th, they're starting to buy these bills. And that really kind of brings up the
Why?
question.
I thought the economy was booming. Everything was great. Kelly's got a solid gold yacht. Everything's fine.
Yes, but they are clearly seeing something now. Historically speaking, the Fed doesn't have the best track record. They talked about inflation being transitory, but nonetheless, they are seeing something. And this $500 billion annualized, it's $40 billion a month, folks. But this $40 billion a month that's starting in a couple of days, that is really surprising. I think that's going to move equities a lot higher because this is I know we had one dissenter wanted 50 basis points. This is like a 30, 35 basis point cut because it's another tool in their toolbox that is getting the same outcome. And it's going to increase the balance sheet, which is crazy that they just slowed the balance sheet down from draining, and now they're kicking it off.
There's a lot to ponder, and I'm totally sympathetic to that. I think you're right about the market taking it that way, no question. But they'll argue that this is it's wonky. It's financial system plumbing. It's that the bank reserves level is getting too low because we're in an ample reserves, not a scarce reserves regime. And we saw this in 2019 with the repo flare, but they don't want it to happen again. So it's more of like a management.
All right, let's go. Let's go. We got 10 minutes. Let me turn this down. We got about 10 minutes before Powell actually comes out. They ask him questions. The next most important thing here is going to be, how he answers some of these questions going into 2026. Should be volatile, but for the most part, this is a much more dovish statement than anticipated. My guess is we rally by the end of the week just based off the statement. How much can the questions really change? Not sure. And we will go over stocks. I'm going to create a new stream. I don't want to do it all in one because this is the most important meeting heading into 2026. Right now, we have home builders strengthening against S&P. The strongest responses right now, genomics, granny shots. Who is this? Tesla moving up? GE Vernova exploding. Here we got crypto, right? Total crypto market versus S&P starting to catch a bid. Let's go through the individuals. But for the macro, you got the move index not really moving. The VIX is falling. The Fed is targeting short-term bills, 2-year rates. They're going to be targeting short-term. And what that means is, watch TLTs. Take a look at TLT real quick. TLT is falling. What does that mean? That means they're dumping long rates. That's not good for mortgages on the initial response. And if we look at short-term rates, let's look at short-term rates. Let's look at bonds, corporate bonds. Are they getting bought up? Not really. Government bonds, TLT, shy. Yeah, complete inverse reaction here. This is very important. And I think it points to CapEx accelerating. This is a straight move to fuel productivity, AI, that will continue. So key here, government bonds, long-term bonds dropping. That means they're dumping them. Higher long-term rates are, more than likely going up. Let's take a look at the 10-year. The 10-year just bumped higher, okay? I guess there's no volume there. But the 10-year bumped up. See this, let's go 15 minutes. Yeah, 15-minute bar. It's trying to move higher versus the 2-year is dumping hard. Why is that? Because the Fed is targeting the 2-year rates, short-term rates going, I think by April, right? By April, that's what they said in the FOMC statement. And short-term rates is borrowing rates for the economy, right? Not for asset prices, but for short-term debt, meaning employment costs, right? Anything in the short term is a 2-year, is less than 2. Well, they say 2 years, 6 months, 1 year. I think 2 years kind of like the end of the short term. And then after that, it's mid. So, 3-month bills, whatever it is. And so what they're doing is they're not lowering, but they're fueling QE, they're quantitative easing on the short-term debt side. They're buying up all the government's debt. This is rocket fuel. I don't care what nobody says. It's not QE. Well, it maybe not to the extent that we're having a financial crisis. This is fuel. This is rocket fuel for markets. We've been waiting for this. We got the government shutdown ended. And then we got, we have the rate cut, and it's a pretty bullish rate cut. Let's look at so junk bond. So yeah, the 2-year. So if you ever want to look at government bonds, these are short-term bonds right here. SHY, short 1 to 3 year treasury bonds building up because this is it. So the yield curve will go back to normal. We're entering a normative phase, and now we want to see that ISM pick up. We have everything but ISM picking up at the moment. Leadership, well, ITB, probably Toll Brothers. Who cares about housing? That's not where all the alpha's at. All right. Let's look at some of these stocks before we get started. We got 3 minutes. You know what? We're gonna have to flip over to the Fed meeting. Here they come. I might have to, let's see. Hopefully this works. This visualization. Let me get this on. So, anyways, we'll come back to this. Let's go ahead and flip over to Powell. I am going to adjust some of this, but yeah, let's go flip over to Powell. He's gonna be speaking pretty soon. Let me know if that comments are working. Or audio, make sure everything works correctly. All right, let's do it.
Could get a different condition called thyroid eye disease, which needs a different treatment. Don't miss any signs. Find a
My name is Oluseyi. I work at Comcast as part of the team that created our AI Highlights technology, which uses AI to detect the major plays in a sports game, giving millions of fans new ways of catching up.
All right, well, we're on commercial break. You guys really, I want to point something out here, okay? 10x returns here. Not guaranteed, but I'm really targeting UiPath. We've been doing a lot. You got to check out the Discord, check out the research. UiPath is, here we go. All right, let's get started. Oops. Well, screwed that one up.
All right, welcome back to Power Lunch. Again, minutes away.
Oh man, you gotta be kidding me.
Positioning where those gains that we had are coming out of the market. So the tech XLK is down about 0.25%. The small caps we'll have to check out as well. Those surged to an all-time high. Silver was part of that trade. The Dow is up as much as a little more than 300 points. A few moments ago, Kilburg gets up 206. So you see the potential for this market to take this and run with it in a dovish direction, but it's going to be really important how Powell emphasizes whether the QE that they're doing is simply bill purchases to help maintain the plumbing of the system or something more meaningful, along with everything else he's about to comment on.
I don't think he's going to give us a look underneath the hood to that extent, but you're absolutely right. That's what the market's going to do.
Let's look at the data side. I like this side better
So,
because it
to
shows
your point,
data
up
on your
20
right-hand
times
side. This
out of
one's way
20
better.
times. By my math, and I went to an engineering college,
It's pretty good.
that's 100%.
It is.
That stocks are going higher over the next year on this cut.
It's not going to be a straight line, Sully. It never is. But when you see the VIX in conjunction with that stat, when you see the VIX, the decay in the VIX, just remember 2 weeks ago when we were a little bit squishy about the actual Fed interest rate cut happening or not, we saw the VIX go up to 28, went back down to 15. When you see that vol get crushed like that, that's when you see people really feel good about equities on a 30-day lookout. And then, yes, that's that, Sully. 20 out of 20 times higher a year later.
What are you listening for as he kicks this off, Kilburg? What kind of feeds to you the bullish narrative versus bringing some doubt into what they've just done?
I think I want him to really kind of give his understanding, will he be sitting on his hands in the next quarter? Because a lot of folks are thinking that we are going to see a rate cut, if not two. Goldman's in the camp that we could potentially get 2 rate cuts in Q1 of 2026. So I want to hear something as he kind of positions the ability to kind of hedge, which he always does a great job of, but that's what I'm really looking forward to get a better understanding. I don't care about the
And then there is Jerome Powell. Let's listen into the Fed chair.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak.
Bro, what are you doing?
The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 0.75 percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral, and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement or repo operations are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So it is, the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing, but that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you ultimately where do you think the bigger risk is? And it's very unusual to have persistent tension between the two parts of the mandate. And when you do, this is what you see. And I think it's actually what you would expect to see. And we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views. And, we come together and we reach a place where we can make a decision. We made a decision today. We had, 9 out of 12 supported it. So fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out. And I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come. But I think ultimately, having cut 75 and, the effects of the 75 basis points will only begin to be coming in. As I've said before a couple of times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted. And that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions. And you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. It can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down? Or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year, but when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3 is not a big data set, but you are right about those 2 3 cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years. And indeed, the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple of things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000. So that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story that that the goods inflation, which is really the source of the excess at this point, that almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall, that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. when it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part that's going on. It's also happening in the context of a temporary few month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed. And I think going back a long ways, we haven't had that in our framework. Our framework, as you know, says that when that's the case, that we try to, take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. That's a very subjective analysis, really, but it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is, but call it the first quarter or so of next year should be the peak. And from here, it should be it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this, and after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got it when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation break evens. And, they're at very comfortable levels. They're at levels consistent once you get out past the very short term now, break evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal. And our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money. And we're going to need to have some years where real compensation is higher, it's positive, significantly positive. So nominal wages are higher than inflation for people to start feeling good about affordability, the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria. Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low twos, right? So it's really tariffs. that's causing the most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month. So 40,000 jobs could be negative 20. And, that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance. And since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much. So it's a little bit curious. Longer term, though, the question is, what are we going to see here? And we don't know, but it's, it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what?
On the committee?
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine.
Thank you, Chair Powell. Christine Romans, NBC News. Wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy? And what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. What we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made it expensive for them to move. And, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time. And so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks, Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods. And we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? So that's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you'll see you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely, but so I think again all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what and it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank? I
don't know. I agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave, sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
Breaking news, Fed Chair Jay Powell following the committee's decision to cut interest rates by 25 basis points while signaling a higher bar for the next cut, what you might call the hawkish cut most were expecting today. Chair Powell saying the Fed is, quote, well positioned to wait to see how the economy evolves. Maybe, though, the biggest news of all today regarding the balance sheet. The Fed will buy short-term treasuries sooner than we thought as well. The chair says to manage reserves, you can call it QE light, call it whatever you want. Stocks jumping on that news. You take a look at the Dow, up more than 1% right now. In fact, the S&P may, in fact, set a new closing high today. We had 3 dissents for the first time since 2019. It does point to the divided Fed that we've all been talking about. Welcome to Closing Bell. I'm Scott Wapner. We're at Post 9. Let's continue the conversation now with our Fed Day tradition. Double lines. Jeffrey Gundlach is with us exclusively. It's good to see you. This may sound so strange to ask it like this, but did we just have a hawkish cut inside of a dovish meeting? Did we just get that?
I don't feel like that was a hawkish cut. I thought that it was interesting that he used the word well-positioned. You opened your remark with that. Well-positioned is the phrase of this meeting. And he went on to basically repeat well-positioned when he was asked, are you really on hold now? And one of the most interesting things was he emphasized this idea that that's new to me anyway, that he thinks that the monthly jobs gains are 60,000 overstated. And so he says maybe a 40,000 stated job report is really a negative 20. And that sounded pretty dovish to me. And as he went on in the press conference, he seemed to de-emphasize inflationary risks. He's gone back to talking about break-evens from the tips versus nominal treasury market, which is appropriate. He's right about that. That's been extremely well contained in the mid-twos for quite some time. So he says he's well positioned, but he really emphasized things like, well, maybe, inflation will tick up because of jobs, being in demand or something, but I don't expect that to happen. He went out of his way to frame inflation as less of a problem. He even went so far as to say they're making good progress on inflation if it weren't for those darn tariffs, So he's trying to carve out some real estate for himself on these things. But when he says he's well positioned, I really agree with him, because at long last, the Fed funds rate is the same as the 2-year Treasury yield. It's fascinating that the Fed has dropped rates 175 basis points beginning a year ago, September, but the 2-year Treasury rate is completely unchanged. So a 175 basis point drop in Fed funds has finally gotten it back down in line with the 2-year. So I think he is well positioned, and he seems pretty clearly focused more on the employment risk of unemployment rising than he is on inflation being a problem. So I think this was sold, was kind of sold to be expected to be a hawkish cut, but I don't think it was. And when you ladle on top of the cut and the language surrounding it with the 40 billion of what some people will call QE, I mean, that's kind of interesting. We've been doing QT for a long time, and all of a sudden, out of the blue, we've ramped up QE, which is probably giving people some hope that there's going to be QE if needed, and I suspect that is going to be the case. One thing that's fascinating is that people keep talking about the Fed cutting rates to help housing. Well, the Fed cutting rates 175 basis points has not helped housing. What's happened is that long-term interest rates have risen as the Fed has cut rates 175 basis points. The long bond, the 30-year Treasury, is up about 75 basis points since before they started cutting rates, and the 10-year Treasury rate is up as well. So I continue to believe, and this has been my thesis since they started cutting rates, and the market action seems to have corroborated my view, that the Fed cutting interest rates is not going to be helpful for long-term interest rates. So today we had the Fed cut, and the curve steepened again. We're out to 230s, out to about 123, 124 basis points. The high this year was 130. So I'm thinking that we might see long-term interest rates actually rise on this more dovish Fed, but I think that this is not a hawkish cut, Scott, in my view.
I mean, I asked it the way I did because you could say, well, Powell says the bar is high for more cuts. As you said, they're well positioned to wait. Those are his words. You say, okay, that's the hawkish cut that we were expecting. But then when they lay on the announcement of the Treasury purchases, the market is at the highs of the day. The S&P could do a new closing high today. You'll say, well, maybe that was actually a dovish meeting because of what some already consider this to be QE light. You get where I'm coming from?
Yeah, I do understand that. The thing that's interesting about this meeting is the dissents. You know, you had one, the Myron guy wants 50 basis points all the time. Two didn't want any cut. And I guess there were a few what they call soft dissents as well. So the committee seems more hawkish to me than Jay Powell's press conference. So I guess in that sense, you could call it a little bit of a hawkish meeting. But from the statement and certainly the press conference, I thought it was more dovish than most people expected. And so when he was asked about, is it possible that we could have rates go one way or the other, you might even hike rates, not just cut rates, Powell's answer was pretty much, there's no way we're hiking rates, is what I heard for the answer to that rather specific question.
Well, he said it wasn't the base case, right? He said hiking rates wasn't in any way the base case at this point, almost as if they're not even thinking about it at this point.
Well, that's right. Yeah, he's basically, one way to interpret that is we need the data to radically change for us to think about hiking interest rates. And my guess is that they're not going to cut rates. I don't think they're going to cut rates. I think he's going to go out with the Fed funds rate. If the 2-year Treasury stays where it is, he'll probably end his term with the Fed funds rate where it is right now. But if they're going to do one thing rather than the other, it would be cutting interest rates. And we'll have to see what that data comes out. He obviously emphasized multiple times that there's a boatload of data that's coming out between now and the next meeting. But we'll see how that goes. But
I'm confused though for a minute though. If you just said that you don't think that he's going to cut rates again, but also noting that the chair said that they think that the job gains were overstated, that maybe the labor market is weakening still, and you still don't think that they're going to cut interest rates anymore. I get that the outlook is for only 1 in 26 and only 1 in 27. He'll be long gone, of course, as the chair by that point in time. But you're making a statement here that they're done?
Scott, I've said this so many times, I'm sure the listeners are tired of me saying this. The Fed follows the 2-year Treasury. They've been out of sync with the 2-year Treasury all the way through this cutting cycle, and now they've actually caught up. And so if the interest rate structure stays stable, and it's been so stable, the 2-year Treasury has been so stable for the past 2.5 years. In fact, most bond yields have been very stable. It was interesting during the press conference, people brought up the mid-90s, because I've been talking about that with my team, that the bond market this year reminds me of the bond market in 1995, where yields were about where they are right now, and they made a push towards 5%, but they never really could break out of a range. And we've been in a range for the past 2.5 years on Treasury interest rates. And that low volatility has allowed for significant stability as well and tight spreads in non-Treasury products like the investment grade corporate market, which had a spread, the all-time low spread of this cycle was 71 basis points. And I think we're at about 75 or 77 basis points now. We have junk bond spreads, which had a tantrum, the tariff tantrum back with the stock market in March, April, but that's all the way back down to about 270 basis points or so. And so they're wider by about 15 basis points off their lows, but they're very, very stable. And one of the reasons that I think credit is very stable is the market for private credit has been absorbing an awful lot of supply. So in the old days, you had the below investment grade debt market was basically bank loans and junk bonds, the high yield bond market. But now it's three pieces. It's about 1/3, 1/3, 1/3 bank loans, high yield, and now private credit, which has boomed in the last 5 years in terms of assets under management. And my view, and there's a lot of anecdotal evidence to support this, is that a lot of the junkier stuff has gone into the unregulated market. That means that the bank loan market and the high yield public market are actually safer now than they would have been at the same spread level, say 6, 8, or 10 years ago. And that's one of the reasons why the credit market has been so stable. And the bond returns broadly have just been quite good this year. The investment grade bond market is over the past 49 years, this ranks number 16 in terms of total return, with many very low risk types of bond investments returning about 8%. You put that together with the stock market, it's been a wonderful year for financial assets broadly. And if you followed my advice for this year, I've been actively interested in gold. I turned neutral on it a couple months ago, but positive on it again last week. So gold has done well. U.S. markets have done well, but foreign markets have done even better. And
Right.
I've been a fan of local currency emerging market debt. That's the best performing sector for dollar-based investors. And also foreign stock markets have outperformed the U.S. So this has just been a phenomenal year for dollar-based investors that have been diversifying. First of all, their dollar-based investments are doing just fine, but their non-dollar-based investments are having a further profit on the currency translation in addition to superior index returns. So this has been, again, it's a lot like 1995, a year where you worry a lot during the year, but when it's all said and done, it's turned out to be a pretty positive experience, no matter how you look at it.
Yes, I mean, certainly our viewers know that full well. If you look across a number of different asset classes. Jeffrey, bear with me for a moment. Steve Leisman's made his way out of the room, our senior economics correspondent. So what is your biggest takeaway? And by the way, I'm not sure if you heard Jeffrey say before you got in front of the camera here that this may be Powell's last cut, that he may be done.
Yeah, we've been talking about that today, Scott, that this could be it. And I'll show you how that could be the case in just a second. I do want to point out that my concern had been being replaced by AI as a reporter. I'm now a little worried about being replaced by Gunlack. And the reason, Scott, is because I came out thinking that the operative phrase of this press conference was well positioned. And I heard Jeffrey say exactly that. And just in case you haven't heard it yet, here's another. Here's one of the 6 times actually that I found Fed Chair Powell used the term well positioned, and I'll talk what I think that means on the other side of this.
We've now cut a total of 175 basis points, and as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
So my question to him, Scott, as you might recall, was the extent to which the Fed is well positioned or has already taken out risk insurance for potential additional downside weakness to the jobs market. And I think what he's saying is, yes, we have. Obviously within tolerance if the unemployment rate skyrockets up, but they're already factoring in some revisions to the payroll numbers. So I think what you see is what you get for a bit when it comes to the funds rate. And again, if you look at the probabilities and why this could be Powell's last rate cut, you'll see that there's a 60% probably they go again in April. That's not tremendous conviction there on the part of the market. More conviction happens when? In June, after the new Fed chair comes in. And just one point of disagreement, Scott, with Jeff. I'm not sure I would call this QE. What's happening is mostly going to be largely on the short end of the curve, mostly going to be bills. I don't know if they'll come back in and sterilize that on the back end after they get through April. But ostensibly, this is to replace or to keep the balance sheet at a given or a fixed ratio relative to GDP and the economy. So, and also to smooth over certain times where there's tremendous demand for reserves. I know the Fed would not characterize it as QE. I guess everybody has a right to call it what they will.
Well, yeah, I mean, look, he went out of his way, I feel like, as well, the Fed chair, saying multiple times, quote, for the sole purpose of managing their reserves. I think because one would understandably say, well, if it's maybe not be full-blown QE, it could be baby QE, it could be QE light. The fact of the matter is, Steve, the market is taking that news, which is going to happen sooner than we thought, as bullish, right? If you just had the Fed chair come out and say the bar is high for more cuts, and we took that as a hawkish cut, I'm not sure that the Dow's up 600 or that the S&P 500 is on the verge of a closing high.
I guess I wonder the extent to which this really does actually, over a longer term, juice stock market returns. Maybe it does. But I will say, Scott, there are those people who are more traditionalists when it comes to the Fed's balance sheet that are rolling their eyes. In fact, there are people who are well in the back of their heads right now that the Fed is managing the balance sheet by doing it this way. There are other ways out there, and people want to see the Fed. People like Kevin Warsh, maybe some of the people coming in to be the next Fed chair, want to see the Fed reduce the size of the balance sheet. It's a separate discussion, but the idea that it has to do that to essentially manage reserves through difficult periods is part of the problem, these people would say.
Gotcha. Steve, thank you, as always. Steve Leisman, back outside the room and spending time with us. We appreciate you down in Washington. So, Jeffrey, you so rightly told me last time that you were looking for a steeper yield curve. And it's exactly what we've gotten, as you alluded to that. Why do you think rates have backed up on the long end the way that they have?
People are worried about the interest expense on the Treasury debt, and they're worried about the fact that the budget deficit is 6.2% of GDP while we're in an extended economic expansion. So they're worried that the interest expense is going to be out of control because it's risen by nearly $1 trillion over the past decade in terms of how much money the interest expense is. So I think that that's really the problem. And it's interesting that the Treasury issuance of the last 12 months, only 1.7% of the Treasury issuance over the past 12 months is 20 years or longer. It's this trivial fraction of the debt issuance. 84% of the debt issuance over the last 12 months is T-bills. So the T-bill market is massive compared to the rest of the total fixed income market in the United States. I'm talking about all sectors combined. T-bills are something like 2/3 of all of the securities that are out there. So it's interesting that long-term interest rates still are rising as the Fed is cutting rates when such a small fraction of the issuance is long-term Treasury bonds. So I just think that the rise in long-term interest rates is not just a U.S. phenomenon. It's happened in all developed countries. We've had the same rise in the UK as in the U.S., over this rate rise period from 2022. And we've had Japan and Germany go up, not quite as much, but they've gone up a few hundred basis points as well. So I believe that's just a global phenomena in the developed world, certainly, that people don't trust the way these finances are being handled. And for that reason, gold has had this ridiculous return. Gold is up this huge amount this year, and silver is up even more, which is actually not a great sign. When silver joins the speculative frenzy of precious metals and it starts to really outperform, I mean, silver's up over 100% this year, usually that, I'm afraid to say, starts to foretell some sort of a problem. some sort of a financial problem. It doesn't mean it's coming anytime in the very near future, but it's a bad sign when silver goes to join a wild speculative frenzy. So I still think that gold has a place in a portfolio, but I also think commodities broadly have quietly started to rally. If you look at the Bloomberg Commodity Index, it's been rising, and now even its 200-day moving average is rising. And of course, the spot, the actual value today is above its 200-day moving average. So for the first time in a long time, I turned positive on commodities broadly last week. So I think a commodity index makes some sense in here. The one thing that's not inflating seems to be crude oil, which is very positive for the inflation side of the dual mandate of Powell. And I think one of the reasons that he's downplaying that side of the dual mandate is because the price of oil has been gradually declining for quite some time now, and it seems to be forecast by the shape of the oil futures curve to be in the high 50s for the next 12 months. That doesn't mean it's going to happen, but it's very rare that you have the oil futures curve predict no change in oil one way or another over the ensuing 12-month period. So I think that the portfolio framework that I've been talking about, gold, and now maybe some broader commodities, foreign investments, non-U.S., non-dollar, local currency emerging markets, and that part of the yield curve that's the real performer, which is the belly that I've been talking about, the 2-year, the 3-year, the 5-year, the 7-year Treasury, that if you owned the 2-year Treasury leveraged 10 times, you've blown away the performance of any other spot on in the Treasury bond market. I don't think that's going to change. I think the yield curve is going to keep getting steeper, and we'll probably end up with 230s going at least to 150 basis points from about 120, 125 where it's settled in for the last few months.
Let's turn our attention to the next Fed chair. We know that Chair Powell's term is up in May. Interviews are starting today with Kevin Warsh. If President Trump called you up and said, Jeffrey, of my final 5, who should I put in that chair? What would you say?
I'd say put the 2-year Treasury in charge of the Fed funds rate, because that's what's always going to happen anyway. It's been happening for decades. But I don't know. I don't have any particular insight on who's going. I just know that who's going to be chosen is going to be a dove, because that's the only type of a profile that President Trump is going to opt for. We just know that. It actually came out yesterday in the news. You know, I've been saying there's going to be one question in the job interview. Will you lower interest rates if I tell you to? Well, yesterday, Trump almost said that it's going to be a litmus test. There'll be a litmus test for the next Fed chair. Are they going to lower interest rates aggressively? So that's what's going to happen. That's why the Fed funds market, you know, they don't expect much of a change in rates. But then in June, all of a sudden, the probabilities go way up because everyone believes, rightfully so, that the president is going to pick somebody who's going to be a dove. And that's going to be a yield curve steepener as well. And it's going to be negative for the dollar. So you should be increasing investments in non-dollar assets, particularly in the emerging market fixed income area, which has been a great performer. But I think this is early innings for the outperformance of non-dollar investments relative to dollar investments.
Jeffrey, stay with me another second. I'm going to go down to Washington. We do have breaking news. The president is reacting to this rate cut. Eamon Javers joins us now. Eamon, what do we know?
Scott, that's right. Take a live look now at the Roosevelt Room over at the White House. The president is meeting with CEOs from the Technology CEO Council, including Michael Dell and other high-tech executives. He just gave his first reaction to the Fed rate cut in that meeting. He said it was too small. He said this rate cut could have at least been doubled. He was not impressed. He called the Federal Reserve Chair a stiff and said that the Fed is too focused on inflation and therefore they are killing growth by not lowering rates even more. So the first reaction there from the president in real time. I also want to flag for you, Scott, a comment that the president made. He confirmed that the U.S. government has seized an oil tanker on the coast of Venezuela. He called it a large tanker, very large, largest one ever seized. So we have confirmation of that news now from the president of the United States. He also said other things are happening. So you'll be seeing that later, and you'll be talking about that later with some other people. So we don't know exactly what the president was referring to when he talked about other things happening potentially in the context of Venezuela, given how he expressed it. But he did confirm that the United States has seized an oil tanker. We expect to learn more about what tanker it was, on what basis it was seized, and what that means for U.S.-Venezuelan relations as well. Scott, back over to you.
Eamon, thank you. Eamon Javers. We'll go back to Jeffrey Gundlach. I'd like to get your reaction to that because it's quite clear we have another dissent of sorts, Jeffrey, at 1600 Pennsylvania Avenue, who says at least doubled the latest cut, i.e. wanted 50.
Yeah, well, what else is new? I mean, Powell took a little jab at Trump by blaming what inflation progress has failed to materialize is because of the tariffs. I think he said it 2 or 3 times. So if you jab Trump, he's going to jab you back and call you a stiff and everything else, because that's just the way he's wired. So not surprising that Trump wants a bigger rate cut, and that just means that we're going to get more rate cuts. That just doubly reinforces what I've been talking about. We're going to get rate cuts after Powell's gone, and it's going to weaken the dollar. I just think this is crystal clear. It's already been materializing. The dollar's already down. It's one of the worst years for the dollar in the last 25 years. And I think that the rate cuts are going to weaken the dollar further. And investors should think about that seriously because it's already happening in real time. This year has been absolutely following that playbook. And Trump is telling you through that outburst that rates are coming down in the second half of this year. And I don't think he even cares what the inflation rate is, Trump. He just wants nominal GDP to go up and just want positive numbers all over the place. He doesn't care if it's inflationary. I care a lot as a bond investor. That's why I'm avoiding the long end of the bond market and playing it safe in higher quality securities, just in case things get out of control and there has to be some sort of emergency stuff done later on. So the QE thing, Steve Leisman, I can't replace Steve Leisman. He knows that. But I did not say that it was QE. I said some people would say that this $40 billion a month for 5 months, $200 billion altogether is QE. But it is. He did emphasize that it's just liquidity management and all that. But the people that want to call this QE, I will give them one tip of the hat, and that is the journey of 1,000 miles begins with a single step, the old Chinese proverb. And when you're doing this now with T-bills on an accelerated basis, it means that you are more open philosophically to doing quantitative easing than you were certainly when you're doing quantitative tightening to the tune of tens of billions of dollars per month. So it looks like they're focusing more on the employment situation, less on the inflation situation. This is not a positive for long-term interest rates in the developed markets and certainly in the United States.
All right. So we know, since we're just talking about President Trump, that among other things, he also wants the stock market to go up. You declared last month this to be, quote, one of the least healthy stock markets of your career. How so?
Well, it's because the valuation is so high, and it's kind of a mania-like in terms of the leaders being, very aspirational. This is reminiscent of prior manias. It's reminiscent of the dot-coms. It's reminiscent of the financing in the housing market. But one thing about unhealthy markets, one thing about markets broadly, whatever you think is going to happen, it's going to take a lot longer than you think. The one thing I've learned at almost 45 years in this business is you might be exactly right on the direction, but it always takes longer than you think. I always bring up the anecdote. I turned maximum negative on the NASDAQ September 30th of 1999. In the fourth quarter of 1999, it went up like 85%. I looked like a total moron because of saying that I was maximum negative at September 30th. But just 18 months after September 30th, 1999, if you had gone short September 30th of 1999, you had a gain of 64% on just one turn short over 18 months. So it'll always take longer than you think. I've been negative on the dollar for a long time. It took longer than I think. It will always take longer than anybody thinks. That's just the nature of the beast. It works in a cycle that isn't days, weeks, or months, and sometimes not even years. So it can stay unhealthy for a long time. But the valuation of the market relative to GDP is very, very high. And it's very high on a book value versus other markets. And I think that it's somewhat warranted by a lot of the policies, the very unusual policies that have been put in place for the past really 15 to 18 years or so. But I'd be careful. I'd be careful that because once it breaks, you're going to lose money very quickly. So this is one of the reasons why I have been substantially underweight the U.S. market, and not regrettably, because the other markets have done better than the U.S. this year. And I think this is not the end of that trend. It may even accelerate as we go into 2026.
Well, there was a lot of catching up for a lot of those other markets to do too. And we shall see what 2026 holds. Jeffrey, you talked about your 45 years, that experience we lean on every Fed meeting for what has become a great tradition for us. I wish you the best, happy, healthy, and I look for you in January. See what happens.
Absolutely. Good luck, everybody out there, and go Bills.
All right. We'll see what happens there too. Jeffrey Gunlock, be well. We'll see you soon. We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. Plus, Leslie Picker is tracking the action in the banks, and Seema Modi has the setup to a very important earnings report. It is Oracle out in overtime. Michael, I'll begin with you. Your take on this market reaction to what happened today.
Yeah, this is a market that was at least wary in advance of what it thought was going to be a hawkish rate cut, and it just really wasn't that hawkish. I mean, I agree with Jeff on that. In the commentary, mostly, I don't even think it's about the $40 billion a month in buying T-bills because that was out at 2 o'clock. Okay, this market actually started to levitate over the course of the press conference and when people digested the kind of committee outlook, which is expect more growth than we thought in September for 2026, expect unemployment not to really go up, and we're still going to price in a cut. We still have an easing bias. In other words, they're not going to stand in the way of the economy gathering pace. The reaction is almost pristine in terms of what you would want to see if the market were gaining confidence in the cyclical outlook. It's value over growth, it's small over large, it's equal weight ripping relative to market cap weight, it's volatility getting crushed. So everything the market was kind of getting in the direction of gearing up for, which is we're going to have a quicker economy, and sure, the Fed can be on hold, but that's not going to stand in the way. I think that's all positive. So this can change. We can have some kind of a shock out there and a rethink in the morning. But for now, I do think that even though they may be on hold, they're not doctrinaire about it. How many times did Powell speak glowingly about the productivity growth of the past few years? He's signaling that they don't really want to restrain the economy in any material way.
Hey, how crazy would it be in the year of AI and the Mag 7 and all that the Russell 2000, okay, which today is up almost 2%, is now up 15.3% year to date and may very well make a run to be the second best performing index of the year before it's all said and done. I don't know how many people saw that coming, but that is the case as we sit here today. It's up near 5% a month.
Yes, it's a catch-up move, obviously. The year-to-date frame definitely flatters the Russell because we're really not up that much from 4 years ago.
Right.
But it does show you that this is the way the market is migrating. And that just says not just cyclical gearing in the market, but also risk appetite's rising. Okay, that's also going on. The high beta stocks are flying. So it's not just, kind of picks and shovels, old industrial stuff working. It's we think we can let it rip a little bit. So we'll see, again, if that overshoots or at all. But right now, it does seem as if you would say that that's a positive risk-seeking signal.
Yeah, there's green, a lot of green on the board, obviously, including the banks. I got JP Morgan up 3%, a nice move back from those losses of yesterday. Leslie Picker is following that, has really spent the last couple of days in the center of the conversation, Leslie, about the banks.
Yeah, banks certainly bouncing today, as you mentioned, Scott, thanks to a lot of optimism from executives speaking here at the Goldman Sachs Financial Services Conference. Over overall, Wall Street firms expect continued growth in investment banking and trading revenue. Consumer spending, they say, is resilient. We heard that word from several executives, and credit quality seen as stable. However, some executives noted the health of the consumer depends on the labor market, which Blackstone President John Gray said was weakening.
The labor market has softened a bit. So when we talk to our CEOs, they say it's much easier to hire today than it was 3 years ago. And wage rates have gone from sort of low fours to call it 3% on an hourly basis in the US. And I think that softening of the labor market, given the Fed's dual mandate, will help them cut rates.
We'll hear more about the labor market and rate cuts in the 2026 outlook from Bank of America CEO next hour. Scott.
Wow. All right. Good stuff. Continued. Leslie, thank you so much. That's Leslie Bicker. I said we're waiting on a really important earnings report in overtime. It is Oracle, and Seema Modi continues to follow that story for us. Hi, Seema.
Scott, it was about 3 months ago in September when Oracle revealed that massive bookings or remaining performance obligations number of $455 billion that sent the stock up 36% in one day. Since then, the stock has erased those gains. So tonight, can Oracle repeat history? Analysts are expecting yet another big RPO number of over $500 billion. But as you and I have discussed, the street also wants details on the speed at which it will continue to go to the debt market to fund its commitments to OpenAI and other customers. This is the first earnings call with Oracle's 2 new CEOs. But as always, commentary from founder Larry Ellison, that will be top of mind. He's widely seen as the person who is the driving force behind the company's pivot into AI cloud computing. Now, worth noting, the stock has rebounded in the last week of 10%. Credit default swaps giving back as well, Scott.
All right, Seema, it's going to be exciting. We'll see what happens. Michael, I'll turn back to you. The importance of this one is what?
It's pretty significant. I mean, we haven't, for all the good things that the market is embracing right now about the macro and how maybe the cyclical parts of the market can work, we haven't called off this really pitched debate about whether we can and should finance the AI infrastructure boom the way we are right now. It's remarkable how Oracle has become the concentrated, touch point for all of these arguments, pro and con. So it is quite fascinating. I think the overall credit markets have done fine, right? They have not really been unsettled by even some of the ripples in data center backed debt. So I think that's a positive. It's much more about how fast can we go? How much confidence do we have about, the demand continuing there? And if OpenAI's got $1.4 trillion in commitments it's already signed up for, how much capital is it going to consume at what ultimate cost? Meanwhile, the world wants to talk about data centers in space now, right? So it's kind of like, it just seems way too open-ended with a wide range of potential outcomes to gain too much comfort in the short term.
Mike, we've been talking a lot about a so-called everything rally. Yeah. Whether we would actually be able to get one between now and the end of the year. There were some signs, then some not. Now I wonder that we get the Fed out of the way. We didn't get to your thinking anywhere close to the hawkish cut that the market was clenched up for. Does this now clear the path for that?
It's hard to see an identifiable obstacle to the market having that kind of a lift. Now, it doesn't mean it's going to be, again, the broadest and the most aggressive and highest momentum, because the market hasn't really indicated that it wants to really hightail it to the upside in a broad way. But, today could be the start of something like that. And at least you have to give credit to what the tendencies are, which is, strong years tend to finish strong, all the things we know. I know everyone wants to talk about how when the Fed cuts rates and the market's within 2% of an all-time high, it's always been higher a year later. That's very true. But it was 2.17% off an all-time high in October of 2007. So if you widen out the scales, sometimes it doesn't seem as much like a sure thing. But right now, I think the market's giving you the message you probably wanted to pull after this Fed decision.
All right, good stuff as always, Mike. Thanks for adding your own insight into this big market day today. So the Dow's going to go out around 500. The S&P is going to fight it out to the finish to see if it can get a new closing high. Doesn't look likely, but you never know. I'll see you on the other side.
That bell marks the end of regulation. Greek American Issuer Day went on the closing bell at the New York Stock Exchange. The National Kidney Foundation doing the honors At the NASDAQ, and stocks shooting higher after the Fed cuts rates a quarter point. The Dow's up more than 500 points. The S&P 500 is very close to an all-time closing high. The NASDAQ with a gain of less than 0.5%. And the best performer today, the Russell 2000. The small caps hit another record high. Industrials and materials, the basics are the top sectors today. Gains also in discretionary and healthcare. The yield on the 10-year note pulling back to 4.14 after this rate cut. Gold and silver higher again, another record for silver. Gains for crypto, Bitcoin back above 94,000, and oil closing at the highs of the day after the president confirmed that a tanker has been seized on the coast of Venezuela.
That's right. Keep an eye on geopolitics, but that is the scorecard on Wall Street. Welcome to Closing Bell Overtime. I'm Morgan Brennan, along with John Fort. A couple big names reporting results this hour. Remember the fireworks after Oracle's last report? We're going to see what happens this time. We have Adobe also set to report earnings.
And Synopsys also due out with results. The company's caught in the middle of U.S. restrictions on chip exports to China. We're going to talk to the CEO before the analyst call.
And Bank of America's Brian Moynihan is set to join us. We're going to get his take on the Fed, on the economy, and so much more.
But first, let's get to Christina Partsinevelos right here for the stock market reaction to the Fed decision.
Well, the Fed cut took center stage along with plans to start buying Treasury bills. Again, the less hawkish tone really helped lift, like you mentioned, the Russell 2000 to a fresh all-time high. Small caps tend to do well when rates come down since these companies lean heavily on borrowing to grow. Regional banks, looking at the KRE, were up big too, closing almost 3.5% higher. The larger names like Truist, M&T, Huntington, Citizens really leading the charge. And that's because lower rates ease the pressure on their funding costs and could help stabilize those deposit outflows. Wall Street's big banks also joined the party with Morgan Stanley and Goldman Sachs, closing at an all-time high today. Over in individual movers, GE Vernova was the S&P 500's top performer after updating its financials at yesterday's investor meeting. An upgrade to outperform from Oppenheimer didn't hurt either. And then on the flip side, Uber was one of the day's worst performers on the S&P 500. And lastly, you have Warby Parker kept climbing today on that Google AI partnership announced just over the last week. They're working together on AI-powered glasses that are set to launch in 2026. Citizens also upgraded the stock today to overweight. Shares closed 27% higher.
AI-enabled hardware seems like it's going to be a big trend looking at 2026. We'll see. Christina Partsinevelos, thank you. Now let's get to the bond market and to the moves that we saw on the Fed today. Rick Santelli is in Chicago with more. Hi, Rick.
Hi, Morgan. Indeed, it was an exciting day in the Treasury complex. If you look at a two-day of 2-year and 10-year, what you'll notice is that after rising right before all the meeting information came out, early in the session, we hit a 420 yield in 10s. Then both maturities dropped, the entire curve dropped, and we had a bullish steepening, meaning we're down 9 basis points on that 2-year. We're down 5 basis points on the 10. Those 4 basis points represent steepening. As you look at the 12-hour 2-10 spread, you can see how it jumped up. It's hovering at 61. When was the last time we were up there? Go back to early September. So it's been a while, 3 months plus. Now, let's look at what's going on with the dollar. The dollar really got hit on today's news. As a matter of fact, where it currently sits now, should it close here, it will be the lowest close since the 20th of October. John, back to you.
Rick, thank you. Well, the Dow's up 1% after the Fed cut rates, and Fed Chair Powell saying the real division within the Fed now is whether to hold or cut versus any potential hike in the near future. Joining us now is Jefferies chief market strategist and CNBC contributor, David Zervos. David, the president wanted a 0.5 point cut here. Is this quarter enough?
I think the quarter's, being rejoiced a little bit in the market just because the market was set up for this hawkish cut and they didn't get it. You got the QE announcement or the soft QE announcement. But more importantly, John, what you really got was a message about how this Fed sees stronger growth without a lot of inflationary pressures. That's what we see in the SEP. And that subtly really changes the ballgame for the potential of a Fed that would get hawkish. Because what gets a Fed hawkish? Strong growth, retail sales, everything starting to kick in. But what the Fed's telling you is that growth is probably coming from productivity. It's coming from not a lot of job creation, actually a semi-weak labor market, and there's no need for them to fight that. In fact, they may need to be looking at cuts because there's too much job destruction as that productivity growth increases. So I thought it was a very dovish forecast.
Do you think that the market estimates are being too pessimistic then, if you're on that side of it, about no more cuts until Powell's gone? And are you still in the strongly risk on camp?
Still in the strongly risk on camp. Certainly excited about our risk parity trades in 2026. And I do think the market is probably on the mark for some slowing of the risk of cuts as Jay's last three meetings come into play for the beginning of the year, but recognizing that as this Fed composition changes, as we learn more about the Lisa Cook trial and other things, this Fed is turning dovish, and in 2026 will be a more of a tailwind to risk assets than a headwind to risk assets. The beginning is a little risky, but I actually think we took a lot of that off the table today with their forecasts. This was a really, to me, a very dovish forecast, a strong growth dovish forecast, which is hard for people to process. But what they're saying is the inflation risks are really not going to be persistent. And he said that a couple times, Morgan, in the speech, that this was really tariff related and one-off related in all likelihood, inflation.
Yeah, and he kept talking about services inflation coming off as well. Stay right there, David, because we've got breaking news out of Washington. So let's get to Eamon Javers for that. Eamon.
Morgan, that's right. President Trump, as you take a live look, still speaking to reporters in the Roosevelt Room at the White House. He was having a meeting with CEOs, that event ongoing. The president's just been talking about the Fed, as you guys have been discussing the Fed. He confirmed that he has a meeting with Kevin Warsh. That's been sort of widely speculated about or reported. But the president also said, I sort of have a very good idea of what I'm looking for in terms of a Fed chair candidate. He says, I'm looking for somebody that will be honest with interest rates. He says, honestly, our rate should be much lower. He says he's not going to be asking the candidates to commit to lowering interest rates, but he says he's going to ask them questions and he'll know what he's seeing in terms of the answer there. So it's clear that the president is putting a low interest rate threshold here on his selection of Fed chair. He is meeting with Warsh, although Hassett has been reported to be in the lead for that job. The president's saying, I sort of have a very good idea of what I'm looking for. One other note here from this meeting, guys, on the Warner Brothers sale. The president was asked about CNN and what he thinks of the prospect of CNN being either included in that transaction or not included in that transaction. The president said he thinks that no matter what happens to Warner Brothers, that CNN should be sold either to the new buyer, that is Paramount or Netflix, or should be sold to have new ownership in charge of CNN. That's because the president says he doesn't like what he sees as CNN's political bias. He doesn't like the content that he sees on CNN. He wants them to change it. He wants new ownership there. And ultimately, the president's saying that he thinks CNN should be sold as part of this transaction. Now, how does that shake out in terms of Netflix not making an offer to buy CNN, Paramount making an offer to buy CNN? All that's going to have to sort out, guys.
Okay, Eamon Javers, thank you. We've got Oracle earnings out as well. Seema Modi has the numbers for us. Hi, Seema.
Hi, Morgan. Second quarter earnings from Oracle coming in better than expected at $2.26. That is a non-GAAP figure versus the $1.64 adjusted estimate. But revenue coming in slightly below expectations at $16.1 billion, likely due to a weakness in software revenue, which again just came in slightly light. If we look at AI and cloud, the remaining performance obligations, which is the key bookings number, up $523 billion.
Oh, you got to be kidding me. I was on pause the whole time. All right. That's fine. We're going to get started here. All right. So Adobe, like I was saying, oh my goodness, you got to be kidding me. Adobe is one of those rare applications, AI applications. We're going to go ahead and hit. Let's do a wrap up really quick on what's going on. For number one, okay, the Fed meeting. As a wrap up, what did we really see? We saw bullish steepening. Okay, I'm going to go ahead and switch over to the macro here. I was looking at some stocks all day. We got bullish steepening from the 10-year, 2-year. All right, so the US 10-year started the day, ended the day lower. Let's just go to that 1 day so we can see. Okay, so we got a bullish steepener, meaning, okay, rates across the board declined, right? Lower, and we're up against that 4%. This is very important for you guys to understand, not in tomorrow day trading, but as a swing trader, as a position trader, looking, 18 months out, looking 3 to 6 months out. Okay, the US 10-year treasury is the benchmark rate for interest rates for borrowing, okay, capital, what, to fuel debt financing, to fuel capex, to fuel growth, all that stuff for the long term. And we've had some tailwinds because it moved from 4 to 4.2%. That's a pretty big jump to the upside. And this is the peak. If this marks the peak, then we should be looking at a rally, a nice little rally here, okay? So we have peak yields, and we saw this a couple times. Damn, my computer's slow. I need a freaking super GPU on this one. Right, we're hitting up against that resistance at 4.2. So we come back down. This is going to definitely take us higher. How do we know this is bullish? Well, we also have the 2-year, the US 2-year rate falling at the same time, right? Therefore, rates across, and the 2-year fell much, much faster for very good reason from the Fed. There's a bullish steepener. So rates are falling. That's a direct increase in liquidity. We should see global liquidity start to pick up, or Fed balance sheet liquidity pick up. Number two, the Fed has completely stopped the balance sheet runoff. Okay, let's go to the balance sheet runoff. So we got rates declining across the board. Okay, and I have this arrow here because this was the drain in liquidity. This was March 2023, $500 billion injection, trillions draining off the balance sheet. We were, what do we go from? 8, whatever. So we've already drained. If we go back to COVID, this is the first time we stopped, right? Since, the first drain was March of 2022. We are near, let's say 9 trillion. We're down to 6.5 trillion. So 2.5 trillion drained out of markets. We finally stopped. That was December 1st, but they announced it today. They will begin QE, and people are going to say it's not real QE. Well, whatever. It is the beginning of purchasing. They're going to begin QT in April 2026. That's what they said, unless they change their mind. So we're looking for April, the beginning of QE, but they're going to be buying short-term treasury. So this is when the QE begins. So maybe this will be flat. Who knows? Either way, that is a complete injection of liquidity, not on a massive scale. We're not going into recession, but money is pumping. This should get the ISM up. I doubt the ISM gets up anytime soon. The next thing is the Treasury General Account. That's our next big thing. So number one, bullish steepener, long rates, short rates, both coming down. Short rates are coming down faster, which gives us a good yield curve. Let's see, do we have the yield curve here? Let's go. Actually, no, that's a very complex thing to find the yield curve. We could do US 10-year, 2-year. See if we can get the yield curve. Bullish steepener. Okay. So this is the yield curve, decline forever. We'll go to a regular chart. We're not looking at, oh man, that's disgusting. So now we have a bullish steepener, which means the 10-year should be rising faster than the 2-year. Okay, March 2025. I think was this April? That really doesn't matter. Okay, no, I don't have the yield curve on here. That's fine. TLT kind of pulled back. I wouldn't be looking for anything long TLT because most of that treasury repurchasing is happening at the short end. So they're pulling down short-term rates, which means that's financing for the next 2 years and below. That's pure capex. That is pure capex financing. The next thing is going to be the dollar. The most important thing was, how is the dollar going to react? Well, the dollar is stuck. It was tightening for a while. This is net tightening. Let's think of it in terms of tightening, easing. The dollar was tightening from September all the way through November. Got hit twice. Now we're starting to ease again. This is flooding. This is liquidity coming back into markets. Why? Because as you purchase more dollars, it goes higher. And if you're purchasing dollars, you're really converting assets into dollars. Now we're converting dollars into assets. Where do they go? Well, that's what I'm here for, where those dollars may go. We'll see what Adobe says. I didn't see the earnings yet. Okay. So the Fed is going to be starting QE, cut rates, QE. It's game over. 2026 is a new, massive bull market. A lot of people are saying, oh, we're going to crash in January, February. Well, we should see a 10% correction because this is a lot of bullishness coming in, and we're going to see a lot more volatility too, but that's fine. Look at the VIX. The VIX got crushed. Now, I thought the VIX would have bounced here. It didn't. It looks like we're going to have the VIX go all the way back to the lows, 14. We'll look out for that. And then a spike going into January. We should finish the year off. I don't know. We should finish the year off very strong. Okay. But the VIX is down. Move index. This is bond volatility. We'll see if that rolls over. If that rolls over, you're great. Is there any risk of recession after the Fed meeting? For that, we go to risk appetite. We're looking at corporate spreads. No, they're falling. So corporations, credit spreads are falling. That's good. What does that mean? That investors are leveraging back into equity debt. They're buying S&P debt. They don't care. They're not buying bonds. They're buying equity debt. So they're buying short-term government bonds because they're going to get paid a yield on it. What is the yield they're getting paid? They're going to get paid 3 point. And this is the 2-year. Imagine the 3-month. You get paid every 3 months. They're getting paid yield, and then they are buying debt, equity debt, to get paid more yield, right? If you want the ETF for that, SHY, this is the short-term Treasury bond yield, short-term U.S. Treasury bond yield. We should be heading back to, you could say, all-time highs. Who knows? I don't know, because Trump is really injecting a lot of money in terms of the Treasury General Account, which takes us next. Treasury General Account, right? This is what we need to roll over. We need the TGA. This doesn't even look right. This is the same thing, but one of them is a little, there we go. This one's a little more accurate here. Okay. We need this to go down. This is the injection of the 1 trillion that left markets. So this right here is a buildup of the U.S. Treasury account. How do they build this up? They sold U.S. Treasury bills, okay, into bills, notes, whatever. Yeah, bills. They sold U.S. Treasury bills into the banking sector. So the banks had to purchase up to $600 billion. It almost capped out at $1 trillion, but from the lows, let's call it 600 billion. So you had a reduction of 600 billion out of the banking sector. That's a lack of liquidity in markets. Why? Because banks, if you remove their reserves, well, they can't take out extra loans, right? You remove their deposit. You removed all these deposits. Not deposits. You removed all these reserves, which means they can't take a lot of risk. They have to reduce their risks in markets. So all that treasury bill issuance bought up by the banks. Okay. So now that's bought up by the banks. Well, there's interest that's going to be paid on this. The Fed just cut that interest. Therefore, it makes more sense now to borrow, go back to the banks and borrow. They need to spend these deposits back into the economy, right? Once these get spent, injection of liquidity. Rates are lower, so it's going to be even cheaper to borrow. This is a liquidity wave on its way. Regardless, we're not looking day to day. I know we have this culture where we're thinking, oh, this culture, we need short term. And why isn't it coming up now? Why isn't Bitcoin at 200,000 now? You got to be patient. Things take way longer than you expect. Okay. They take a lot longer than you expect. And I have 3 stocks, I think, boom. One of them I'm really keeping my eye on. Okay, you already know we're long with crypto, but you have a lot of liquidity about to head into markets, especially now that the Treasury General Account, this is Donald Trump or Scott Bessent, this is his liquidity. This is headed lower, right? That's an increase in liquidity, meaning they're spending this account back down. Your bank account goes up by 10,000, you spend it down. That's an injection of liquidity. Thinking about your bank account, you're injecting liquidity into the economy. I know you're like, duh, whenever your bank account goes down because you're buying something. So this is coming back in. All right. That is a liquidity increase. We should be seeing global M2 accelerating. It's already breaking all-time highs. So M2, global M2 should be absolutely, let's go to the area. Does it look better like this here? That looks better visually. Okay. Global M2 heading higher. It's already breaking all-time highs. So what do you think is going to happen over the next 12 months? It's going straight up. Okay. Despite the Fed's balance sheet, this is a flood of liquidity. These boomers that are on, TikTok or on X saying, "Oh my God, we're gonna collapse." Dude, I'm sorry, these dudes are caught up in the past. The market is going to rage. Absolutely. Yes, we're gonna have more job loss or weak job markets because of all the AI picking up. That's why these stocks are rising, like Palantir. Okay. Palantir, Nvidia. I mean, we can go through the whole AI stack. I wanted to make a new video for that because I don't want to have to go edit this, but we can go through the whole AI stack. Should I just do it here? Maybe I should just do it here and just get highlights later. Either way, the Fed is cutting rates. They're injecting liquidity. It's game over. Rates are falling. You want to be long. We have consumer discretionary starting to pick up. We need this to beat out SPY. This is market strength right here. We need this to beat SPY. Another bullish thing is going to be market breadth. Okay, this is what we needed. Market breadth to expand. We got the equal weighted average versus market breadth. We did have a divergence for a while. Okay, there we go. Here's our divergence. We had this divergence where the advanced decliners were increasing. We said, hey, this is bullish because we're increasing advanced decliners. At the same time, let's take that off. And at the same time, we're decreasing in terms of S&P equal weight. So there was, we're decreasing, but I said, hey, look, there's more stocks advancing. We broke to all-time highs a couple days ago, last week, I'm sorry. And then we retraced, boom, today, advanced decline all-time. There's more stocks advancing than declining. And as a matter of fact, we're at all-time highs. Now the S&P equal weight is at all-time highs. Is the SPY even at all-time highs? How do you know our S&P equal weight, RSP? Damn, this thing is slow. So equal weight, all-time highs. That's bullish. Okay. That means if you look across the entire stock market, you're not like, oh, it's heavy by Mag 7. No. Remove Mag 7. Make all Mag 7 the same as the 499th S&P company. They're weighted the same. So this is a better measure of the broad overall market. RSP, equal weight, all-time highs. SPY, not even at all-time highs. So this is a strong market breadth signal that, markets are very strong. I am a little worried about some positioning things that I've seen. So you have to, or I would say you want to be long these stocks that haven't played out yet. Okay. I guess we can go through those. Let me try to do a screen reset. So when I do an edit, I can I can come back to it. So I'm going to turn this off. Or wait, I'm going to remove this. I'm going to keep it black for a couple seconds so I can find this. You kind of know what I'm doing. And for the most part, let's see, is S&P out of the woods yet? Let's look at Adobe. I'm going to look at Adobe. I'll just speak through this. Okay, Adobe is rising in after hours. That should be long enough. Yeah, that should give us a good reset. Make sure we didn't miss anything. Oracle, the biggest surprise, another couple of. Yeah, forget what the Fed has to say. They're cutting. All right, here we go. All right. The last thing we really need is for crypto is the Clarity Act and the ISM. ISM, as we said before, ISM and Clarity Act is what we need to really get going here. So Adobe looks good. ORCL, Oracle has that debt problem. So, it looks a little trashy, but I'd still be long. Now let's take a step back. Okay, I think the market is rotating, is going to try to rotate into, we got to put this on the logarithmic. I think the market wants to rotate into software, right? A little bit into software, cybersecurity, automation. Cloud is already kind of stuck. Oracle represents the cloud infrastructure, and that trade is very exaggerated. I mean, it was $1 trillion, now it's not. Okay. Let's just go to some of these. We're gonna go through this whole AI stack here. Okay, I'm gonna show you what I think is really looks good right now. Applications look great. So if we were to start, prepare yourself. I'm gonna fly through this. Prepare yourself. We're gonna go fast technicals. Okay. We still have, I think tomorrow is a really good day to look. I think we're gonna do another stream tomorrow. Now that we're past the Fed meeting, we said, hey, we want to get past the Fed meeting. We need the government to reopen. And I mean, that's all you need for a year-end rally. Okay. QQQ. Where are we at? Oh, cool. QQQ. What we want to see is where's total crypto. Okay. Total crypto. Total market cap of crypto versus SMH, because that's really what's leading the market is semiconductor chips. Once you get this rally, crypto versus SMH, crypto is going to rip. We're not there yet. We're not there yet. The chips have the most revenue. You got to understand in the entire AI stack. See if I can bring up the AI stack. Have it somewhere. If you look at the entire AI stack, why can't I just double click this? It'd be easier. If you look at the whole AI stack, you have a lot more margins and profitability in the beginning of the stack, not necessarily the whole beginning. Here it is, right? And this is going to be in my newsletter. This is going to be in the newsletter, and this is in our Discord. This is something that I'm creating on the Discord so you can see all the companies that are within the stack. Power, land. These are data centers. This is electricity power generation. Those have got a bid, but one thing that has not is energy storage. We're going to go over those companies, energy storage companies that have not received a bid yet. They're going to need it. Power, land, compute gear. This is what's the most bullish. This is SMH. This is SMH semiconductors, GPUs, networking, interconnector, servers, racks, blah, 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 chips, blah, blah. So this has the most money. I think this trade is starting to peter out. I can see when I look at the technicals, it's topping. I think this is the last run before it takes a 6-month break in compute gear. And we're going to see those. I'm going to show you. Cloud hyperscalers has nothing to do about that. You already know Amazon, Google, Meta, Microsoft, Oracle. So cloud hyperscalers, there's not much to say. Everybody sees those. Those are the most popular stocks in the market. Who's the best one? Google has the best, fundamentals. If you guys want to see fundamentals, throw a comment. Throw me some comments if you want to see a couple fundamentals. I found a new app. It's called Full Ratio. It has very good visuals and helps you get more insight on these companies. So you understand who's profitable, who's not, who has the bigger risk, who doesn't. Core AI models, well, there's not really, it's the same thing as hyperscalers. You're looking at ChatGPT, which is, a private company. You could say Microsoft. You're looking at Amazon's using Anthropic, but it's not really Amazon. Google's the pure play because of Gemini. Damn, who else is the freaking models? Grok is not public. Elon might do it though. Grok is not public. I think that's it. That's all the big models. I might be missing a couple, but those are the big models, right? AI tooling. This one's very interesting. This took me a lot to research and understand. We're going to go through those databases of observability. This is where cyber falls in. The apps and the agents is the most competitive landscape by far. This is the hardest to find, to know. You have to watch the technicals. The hardest to, this is what the battle is about. Power, land, compute, hyperscale, models, AI tool. All this is to finish off the apps and the agents. Okay, the applications. This is where there's only going to be a couple winners. Actually, no, I'm wrong. There'll be a lot of winners, but they're going to be high multiple expansion in this area. Okay, stay tuned. Subscribe to my newsletter if you want to see the Discord. Check it out. I'm gonna throw on the Discord link right here so you guys can keep up. You hear what we're talking about. Here's the Discord. Go ahead and join it. Okay, join the Discord. And as I have that up there, we're going to switch to the charts. We're going to run through these bullish charts. We said, hey, there's going to be a correction. We're going to get a correction. Now, I didn't know how long it was going to take. And we said the resolution of that correction would be, okay, the resolution of that correction would be the Fed cut. Getting past the meeting, now the Fed has cut. And now it's pretty clear that we're going to get a this is greatest macro setup of all time. Scan that QR code. Actually, if you're on your phone, I guess, how would you scan it, huh? Some of you guys are good tech savvy. I'm not. I'd be like, wait a minute, bro, I'm watching you. How am I going to scan the QR code? They need to do something with the devices on that. All right. So we're going to go through this, the AI stack. First and foremost, we have the Mag 7 here. Okay. We can go through the AI stack. The Mag 7 starts, we have TSM, which is part of the semiconductors, right? They're at the base layer. But the Mag 10, I call, right? And we're going to add more to this, is just the base layer. As long as these stocks are trending higher, we're in good shape. On the weekly, we want to start with the weekly, and I'm going to throw on the 50-day moving average. Okay. This is a masterclass in technicals, in trends. This is your master class here. If you're new, if you're used to this, you probably are going to be like, oh, dude, that's not how you do it. Try this. Or he doesn't understand. That's fine. If you got your way, there's a 10,000 ways to skin a cat. For those of you who want some confidence in where the trend is headed, this is it. TSMC is not the absolute cornerstone. It's actually ASML. Okay, ASML has a monopoly on the technology that creates semiconductors. Finally, ASML is breaking all-time highs. Okay, they create the chips that TSMC brings, right? This is the base layer technology. I should have ASML in there. I'm waiting for them to hit $1 trillion market cap. They're not there yet. They'll probably hit $1 trillion. But ASML is at the beginning. Then you have TSM. Does it look like we're in a bullish trend? Yeah, we're on the weekly chart. Okay, we're on the weekly chart. Can you go to the monthly? Sure, but you don't really need to. Amazon, still bullish, holding the 50-week moving average. Okay, we only look at the 200-week moving average when we're in a big 10% drawdown. But right now, we're not in a big drawdown. We're at all-time high, so we don't want to see the 50. Are we holding it? Great. Is there any trend threat? Hell no. Tesla, boy, Tesla's fundamentals are trash. I'll tell you guys right now, Tesla has trash statistics. The fact that the stock is still rising off trash fundamentals tells you that this is not about cars or growth rates. This is about unleashing robotics and energy storage. Okay. So Tesla will break out soon. This is the beautiful chart. It looks great. Okay. Broadcom just made all-time highs. Why? Because they're producing TPUs for Google. They're the ones producing the new chips that are supposed to be for, GPUs could be for anything, but these are TPUs, tensor processing, which are specialized for AI specifically. Well, who knows? Who knows who the winner is? All we know is that Broadcom is at the beginning of that space. Okay. Google all-time highs, best valuation. The price is up too much. So look at that. It's overbought. The price is overbought. Join the Discord over here. The price is overbought on the weekly. So Google is not a buy. You want to wait for it to get closer to the 50-day moving average, or at least the midpoint in the Bollinger Band, which is going to be about 250 right now. We're not even close to that. Okay. So it's not buyable. How about Apple? If you're investing, this goes for investing too. We're not even talking trades. We're looking at the overall market trend. Nvidia, by far the biggest stock in the market. Okay. I guess not by far now, but Nvidia is consolidating. If you really look, 135, Nvidia has been consolidating for half a year. Okay. This is very healthy. This tells me there's so much more room for semiconductors to run, but you have to pick your spots. They're not all going to go up. The market is now not punishing, but the market is now being very specific about which semiconductors stocks or which part of the AI stack. Remember the AI stack as in, where's that damn AI stack at? So I need to be able to visualize it so I can explain. Okay. And guess what? I have the whole AI stack pretty much in my, in the newsletter, the investing newsletter, and that is free. Okay. And in the Discord, it's broken down into the actual stocks that fit in each part of the stack. So GPU accelerators, this is NVIDIA's number one thing. This is how you build AI, increase AI's capacity. Well, this stock hasn't even moved. So really, you could invest in NVIDIA now. I was not for a while, but they have very good, the PE is not elevated. We are talking, technicals right now, but I'll tell you right now, looking at the fundamentals, they look great. It still looks like it has some downside, but usually you can bounce in an uptrend on that 50-week moving average. I'm not worried about that. We don't need to go all the way down here. In the daily chart, you do, but my guess is NVIDIA's already reset on the daily. I guess it hasn't. Well, maybe it has some more downside. You never know with this market. Okay. That's fine. There's a lot more opportunities out there that don't need NVIDIA to really go up. Oracle, this is a buy the dip. This is a buy the dip. They're going to come out with who knows what pure AI, platform. Who knows what they're up to? I have to look deeper into them, but I think this is going to turn out to be a buy the dip. They might have a little more downside. If you cross above 50, that's game on. Everybody's worried about their debt, but guess what? The Fed just cut the debt even lower, made it cheaper for them to find more financing. So not really concerned. It looks like you're going to have this could take another 2 or 3 months. But if you're investing, you definitely want to nibble around 200. Okay. Meta's trend is great. There's no issues with Meta's trend. Oh wait, never mind. Hold on. Oracle bounced at the 50-day. Okay. Meta's trend. Meta looks weird, but Meta's very volatile. It has an uptrend. Let's see. Meta just trends higher. What I would say is that you're getting a bottoming happening down here. The daily looks way better. As a matter of fact, you could have traded options on the daily. Now it's hitting that resistance, but the daily got oversold and it blew up, went from 585 to 685, almost 670. Good trade, but maybe it has more room for the downside. Who knows? All right, let's move on. Microsoft still on trend. So as long as the Mag 10, right, the $1 trillion companies are trending higher, then the trend is in stack. And then you having macro start to pick up, as we talked about. Now let's move over to the next part of the stack, which is not really talked about in the stack, but you have Albemarle. Okay. This thing did just never stop. We initiated a buy back here at 90.88 and, just kept going higher. I got stopped out. I missed the trade, but that's a big trade. You want to see a pullback, maybe in a 110. Maybe it'll come lower. Who knows? But it's overbought now. It's not worth the trade. Copper's starting to trade up. Do I want to buy copper? Nah, not really. I don't really care about copper right now. This is, who knows what this is? I don't know. This is batteries. This is too small of a cap. Not interested. They're not earning money. MP Materials has a bid, national bid. This one, I think it has a little more consolidation. If you look a little closer, you can see it's just forming a flag pattern. So I think it has more room. I think software is the trade. We're going to get to software. The rest of these, not interested. Okay. Next part, power, nuclear power, BWXT. Now these are going to receive the nuclear stack, or the nuclear trade is starting to pick up steam here. Is it ready yet? I don't think it's ready till January, simply because the year-end rally has to catch. There's going to be fund managers chasing winners and selling losers. None of these are really big winners outside of like Oklo, right? Oklo's probably going to catch a bid. Chemical Corporation looks great, biggest nuclear supplier of uranium. And but do I want to own this if I have a lot of capital? Maybe, maybe not. So it's still in an uptrend, looks great. We're looking at weeklies. Why it's not oversold yet? That doesn't have the most juice in it. Oklo, does it have the most juice in it? Well, guess what? After the Fed cut, it declined. Not interested. I'm not interested in Oklo yet. It either was going to bounce hard or it wasn't. It had a relief rally, and that just gives me more trend. You got to be patient here. Don't go chasing Oklo yet. Okay. It's below the 50-day moving average. So that tells you that as it bumps into, like here would have been great. It's on trend, but it bumped into it. Don't buy that. Wait for it to really retrace back to the lows. It would be great to buy it lower. This is an accelerator. I could be wrong. This thing could break out. But what I'm saying is when I go to the weekly chart, it has more weakness. Okay. Bollinger Bands. Where could you get it at on the Bollinger, as far as Bollinger Bands? It needs to really get above 100 and hold. I don't see anything here. I don't see a buy here. How about the EMAs? Nothing. Nothing. Anchored VWAP. Nothing. How about it needs more consolidation? All right. I think that's it. It needs more consolidation. I've been watching the nuclear stocks. There's NRL, nuclear, no. NLR. This is an ETF, uranium, this thing has bounced. It looks great, but it looks good for a bounce, but after the Fed cuts, you're not getting any acceleration here. Okay, look at this bounce today. Nothing. It sold off and it came right back up. So I don't think it's ready yet, neither quantum. Why? I think we are moving into, and I'm going to say this again, we're moving into, because the market is about price and it's about emotion and confidence in the future. Investors don't want to go chase stuff that's overbought right now. They're too scared. They don't want to get ripped. They're even unsure after the Fed meeting. So what does that mean? We need to wait for the profitable stuff. I'm just going through everything. SMR, I think this is going to be a buy pretty soon. Not yet. Didn't bounce. Okay. Next one is going to be NEE. Okay. I like this one. I think it actually has a little more strength, but still not ready. The RSI, none of this screams buy. None of it screams buy yet. Doesn't scream, you could try to catch a falling knife, but I don't think so. Now let's move over to energy storage or battery tech. I don't think we're ready here either. Okay. But this is one of the big narratives that is going to come into the market this year. We need to compete with China. Solar is the most efficient way to grab energy, cheapest. So who can make these solar? Oh, look at this. Energy vault already exploding. So we have some life here. We have some life. This is energy storage solutions. Oh, wow. What is our market cap here? How much room do we have to run? How big can the energy? This is a small cap energy stock. Bro, you gotta be kidding me. Small cap energy stock. How did that get in here? All right. Anyways, small cap energy stock, solar. This is solar power, energy storage systems. Okay. I'm still new to this stock, but it's a little overbought. It's a small cap, so it can still run. We'll keep our eye on this. Okay. Energy vault hold. We'll keep our eye on it. In phase, this is what I think has an opportunity to be one of the biggest trades in the entire market. It has an opportunity. We don't know yet. Okay. Why? Because the fundamentals are solid. Okay. It might be forming a reverse head and shoulders, but who cares? We need the breakout of 40. All right. We need a 40 breakout. I put in a couple options to see how it moves that are, 6 months out. Small, nothing big, but it needs time. It's been oversold for so long. There's a lot of bullish divergence. You can go all the way out to the monthly chart. So when this thing springs, it's going to spring. The monthly chart, you're finally starting. This one, you have to go to the monthly. You're almost getting a crossover on the MACD. Okay. Almost. Right. Almost. Not there yet. Once you get the crossover, then you're going to be more, it's trying to cross over. You'll have more confidence about taking this trade. All right. Or invest in, maybe you want to invest in phase. I don't think it's a bad investment, honestly. Maybe you don't want to burn theta, right? You also want to see this crossover. So phase, you're looking at the monthly. The monthly is probably the best recovery monthly chart that I've seen. So for this, you want to see, let's go to Bollinger Bands to see that volatility. You want to see it really, look how it's never, take out the EMA. Look how phase hasn't tested the red band yet. Okay. Look how it hasn't tested the red. And I'm going to spend more time on this because of the opportunity here. Micro inverters for residential energy store. I think it's a 10x opportunity. The last time phase really tested the upper Bollinger Band, which told you there was real buying power or shorts getting squeezed, was back in 2024. Last year, right? Over a year ago, right? Or less than a year ago? Less than a year ago. April, May, June. Well, I mean, it did it all, did it all through here. So you're talking, what, 9 to 18 months ago. We haven't got that. Once we get that, then you want to see the retest of the Bollinger Band. You want to see it press into the red line on the Bollinger Band and then pull back. That's the buy. We're not there yet. Then you'd have a crossover on the weekly, the monthly, and the daily. You'll have a triple crossover with the MACD, and it should be good. Okay, how about Sunrun? This thing is just completely stuck at 23, right? If it breaks out, I think the short squeeze, it's like 90%. Like it's going to squeeze. It's going to squeeze nasty. It'll eventually squeeze, so keep your eye on that. Microvast. Now we're moving into battery technology for EVs. Well, you're cutting rates. This thing is in China, has one of the best trends. This one on the weekly chart looks like it's starting to roll over. It had a lot of momentum. I don't know what's going on. I haven't looked into the fundamentals. They're okay. It's not a profitable company. Like I said, I think you need to be a profitable company. I don't know. That's what the market's telling me. The market's telling me, hey, we want profitable companies or oversold. We'll see. Microvast might make a comeback. Enovix is very risky, very high risk, but they are making a unique battery solution. So you just got to wait. It looks a lot like Symbiotic price action. When it breaks, it's going to rip. It's just not there yet. Fluence Energy, very bullish. This is one of the 10x stocks I have on. Okay, they have billions in backlog. This is a 4 billion market cap. We talked about this before, absolutely ripped. This is one of my top stocks to be holding over the next couple of years. They are second only to Tesla as far as energy storage solutions. They create these mega pack batteries, and they have software, and they have a lot of deployments, and they're focused on big utilities. So they're building for like the big utility companies. Okay. And they're not profitable yet. They're back and forth. They just did a bunch of investment. When they sold off, is because they were investing. The market didn't know if there's enough demand or revenue. I've done some fundamental analysis. I'm very bullish on the stock. I'm pissed off that it's up too much. I want to see a reset on the daily. You can see the bearish divergence coming in here. This is bearish divergence. So if we get a rollover, I'm hoping it rolls over. It looks like it's so strong it doesn't want to roll over, but I hope it comes back to 16. I'm buying it. It might not. It might just rip through. Okay, it might just rip through. Got to stay patient. Do not chase this stuff. But Fluence, I'm very bullish on. EOS, look at their fundamentals are trash. I know the company has a lot of promise, but that's what it is. It's a bunch of promise, not a whole lot of delivery yet. It's just a bunch of contracts. That doesn't mean shit to the market. Wants to see revenue over time. This is very solid state batteries, right? We're not even going to talk about these. They have no earnings. Okay, QS has no earnings, not profitable. They're losing a bunch of money. I'm not interested. AMPX technicals look good, but let's move on. Let's move on to the stuff that's going to get some revenues here. Power generation. Okay, GE Vernova. It's already up. It's already breaking out, but you can trade this one intraday. It'd be a good investment. It kind of sucks they moved up so quickly. I literally took my contracts out. I was like, why is it taking so long? Now, if you get a pullback to all-time highs, then you could own this, but this is one of the top power generation. Let's just say in the AI stack, when it comes to power land, they're the number one power company. Okay, number one, number two power company. Something similar to GE Vernova, well, not similar, but has the same unique profile is Quanta Services, because they build out the infrastructure for electricity and power. They're building infrastructure. Stock just goes straight up, kind of pisses you off. Maybe you want to own some of it. Is it a good trade? And only when it dips hard. When it dips hard, sell puts, right? Big bid. Now, this one I think is tradable. Not yet. As long as it keeps consolidating. This is the number one nuclear facility company in the world. Well, in the US. China has a bunch of nukes. But Constellation Energy is number one for nuclear power. And then we have Bloom Energy. We'll see if this has potential. These are not the big, Nextra. They're just not ready yet. The market's not giving us a buy here. What about compute? I have a couple. Data centers, right? Bro, you got to be kidding me. You got to be kidding me. Stop. All right. So data center, when it comes to data centers, VRT, probably a good investment, but I don't like it yet. The market is not favoring these yet. There's no bid here. Hut, they own Bitcoin. So I think this one could actually move higher. I like this one. They do nat gas, right? So they mine Bitcoin and they do high performance computing. And so I think they're going to be great. I mean, who knows? But the technicals are not there for the best trade. Although I'd keep my eye on this one. It looks like it's trying to recover. All these look the same. Hut, Iron, look at this, same price action. They're trying to recover on the daily, but the weeklies don't look great. Okay. I don't want to, I'm just walking you through. We're paying attention to the whole AI stack, Powered Land, Applied Digital, same thing. These are rolling over. I don't really like them too much. CoreWeave, on the other hand, this one might have some juice, right? It doesn't have a whole lot of metrics. This one might have some juice. The big negative for CoreWeave is that, yes, it came back, it's starting to accelerate, but the problem, you got to be out, you got to go further out if you're doing options. The problem with CoreWeave is they're heavily indebted. So the cut should help them, but the market is just not buying into it yet. It's a bigger company too. It's 30 billion. I'm bullish on CoreWeave, right? Nebius Group is a similar stock, but right now the technicals are not getting favored, right? We're not seeing favorable technicals. How about Cypher? They hold some Bitcoin. I think they do. They should. Okay. Now, if I had to pick one of these, I want to go with who Google's invested in. Look at these. Look at the weekly here. It's still accelerating. It's not rolling over. It's shown a lot of relative strength. It's not the best in the market, but out of these, TeraWulf is showing a lot of promise. I like TeraWulf. Okay. Let's go to the weekly. I'm sorry, that was the daily. Maybe the weekly looks like trash. Yeah, I guess the weekly looks the same. Let's move on. Memory storage. These are your top stocks for the AI stack when it comes to chip storage. Okay. WDX. This is Western Digital. This is a number one stock, all-time highs. You could trade short puts on this when it dips because it just keeps going up. Why? Because the backlog is insane. There's not enough. You have to trade these on the daily. It is accelerating, could have another bump up. Not interested in this, but I'm keeping my eye on it. When it comes into that 50-day moving average, it's usually a dip buy because the demand for storage solutions, like how do I say this? Storage is like I don't know. I'm not a technician, but it's memory storage, right? Now Micron's number one for that, and they're still going higher. Still going higher. There has to be a bid in Micron. They're the number one supplier for chips, for memory chips. And the bid for memory chips is insane. So you'd probably own this. I mean, I took my options off because I was like, does it have a lot of juice? I don't want to, wake up one day and they're like, oh, we don't need this. SanDisk, same thing. So these are all memory storage and networking. I think Intap is networking. You could look at Cisco, probably looks the same. But I'm not interested in these. I think they're nearing the end of their upcycle. Okay. How about chips? Well, Qualcomm uniquely is not even close to all-time highs. This is one I'd keep my eye on. Let's go to the weekly. It is crossing over, starting to accelerate. I like this one. They're also getting into inferencing, which is a big total addressable market. I'd keep my eye on. They have fundamentals, strong business. Qualcomm is clearing a 12-month resistance level. Okay. After getting slammed and just supporting that 50-day, it's breaking out in my view and is getting into robotics, which is one of the next trends that the White House is talking about. So Qualcomm to me is something you keep your eye on. Marvell, building specific type of silicon chips for, I don't even remember, but is it ready? It's not the best chart, but if it dips, into 80, 70 in the 70s, I think it's a dip buy. Not too excited about it. AMAT's overbought. Yeah, these are all overbought. AMD, I think it still has time to it looks like it's going to roll over. SMCI, on the other hand, is one of the top company, and this one is not. This one's almost ready actually to bottom. SMCI, did I say AMD? SMCI is one of the top AI rack server companies. So they build the AI racks. This for data centers. I think the revenues are going to be. I think you just got to wait for they're failing earnings. I don't know why their earnings are so trash. Right, I have to look deeper into them, but the technicals look like it's almost ready. When this stock rips, it rips. Dude, get off. Back up. Oh my gosh, I got a glitch. You got to be kidding me. You got to be kidding me. Save and reload. Too many things going on. I need to hurry up and get to software. That's what this whole thing was about. Oh my goodness. You got to be kidding, bro. You got to be kidding me. All right, here we go. Damn, the VIX got killed. We're going to move to this chart, okay? We're going to move to this one. Let's go to the weeklies. I like this one. All right, so what were we on? Qualcomm was the only stock in there that I really liked right now. I like Qualcomm. SMCI, boy, this has some potential. So I say Qualcomm, SMCI right now. Keep your eye on. The rest of them are a little overdone. Now, workflow tooling, okay? This is where AI is moving into. We're moving into the companies, like when it comes to, building the stack, you need memory, you need all this infrastructure, but that infrastructure, this is software. You know how the chips, when it comes to AI, they say that the picks and shovels, Micron, NVIDIA is the picks and shovels for AI. Well, that's hardware. This is the picks and shovels for software. So there's going to be some big winners here. Elastic is, I want to say is it observability, orchestration? I think it's vector databasing, which is a bunch of technical crap. GitLab does some stuff. These are not ready yet, but check these technicals out. Oh yeah, this is what I want to see. Now we're getting somewhere. These are ready. Twilio, okay? This is it. This is it. You want to be long Twilio? Okay, this is a trade back to who knows. I don't know where it's headed, but Twilio is accelerating. The momentum's picking up. This is AI tooling infrastructure. AI tooling infrastructure for communication, more specifically. And look at that beautiful wedge pattern. This thing is going to rip. All right. So this is one that I say, hey, you want to be long Twilio. Put that in your back pocket. Okay. Next, MongoDB. Well, it's a little overbought, but come to find out, you need MongoDB. This is data. Let's just call it big data software, where Twilio is more so tooling. This is big data analytics slash what do they call it? Vector databasing. It's too nerdy for me to explain it. I just know they're in big data and their revenues are accelerating significantly. It's almost like the AI need stuff like MongoDB to, to farm data to create outcomes. Frog, I haven't looked into it enough, but it's already overbought. That thing exploded. That's one of the software plays, right? This is HubSpot. I don't know. I've heard HubSpot is getting disrupted. Not interested. Teams. This is one of the top rated, workflow automation. Okay, it's called Team for a reason. And the technicals are turning up. You're getting the MACD turn up on the weekly. The RSI is overbought. It's ready to pick up. So who do we have first? We had Twilio and we have Team. And look at that. This thing's at a bottom. So make sure you keep your eye on Team. All right. It's starting to accelerate. I'm not going to get in granular detail. We're more doing a macro outlook and all this. I'm not going to get too granular. CRM. CRM just acquired two of the biggest data infrastructure companies. They acquired 3 companies in the last 4 months. They are eating up other companies. This is a flag pattern. It's going to break out. Call it a wedge if you go all the way up. So I think when it comes to, I think it's already breaking out, to be honest with you. I'm just trying to stay very patient for a pullback here. I want to see a little pullback before I get long. I was looking at so many options today. Just didn't find anything, but CRM is the leader in, I guess you could say AI enterprise application. Okay, AI enterprise application. But the technicals look great. The daily's telling us it's accelerating. The weekly, we're getting we're above that halfway mark. So I think CRM is one of those plays you have to be long. It's a monster. Workday, not interested. ServiceNow. Okay, ServiceNow is number one, IT solution. So this is more, Salesforce is more of like, sales and marketing. ServiceNow is like back end, like, okay, how do we deal with HR? How do we deal with, I don't even know, dude. I'm not that, I'm not a tech guy, but I've read a lot of the research, and this is a top stock right here. This is, they're going to come out with some agentic stuff pretty soon. Now, I don't know how long this is going to take for this big wedge to form. I don't know how long it's going to take, but the technicals tell me it's almost ready. Almost ready. The daily looks better, but it's almost ready. It's just not there yet, but you can see this flag forming. This is you want some service now. They're ahead of, Microsoft in a lot of things. Like when it comes to mega caps, it's ServiceNow, it's CRM, and it's Microsoft. But Microsoft is, not here. We're not looking at Microsoft. Pegasus System, workflow automation for finance. Very great stock. I don't think it's buyable right now. Okay, this is the number one stock. I'm just going to get straight to it. This is the number one stock you need to be looking at for potential. UiPath just turned profitable. Okay, I'm going to do more work on this later. They just turned profitable. They're trying to get over this, volume shelf here at 20. Once you get above 20 and hold, it's game over. You can see the weekly already bounced, but it's a small cap. I mean, it's 10 billion. I guess it's not small anymore. It's a mid cap company. It's in the sweet spot. Their revenues are accelerating. Their margins just turned positive 2 months in a row. It looks a lot like it's comparable to, I want to say, Palantir. They don't do the same thing. Palantir is more, unstructured data, creating these models for unstructured data. But UiPath is straight automation. This is the number one rated automation platform for workflow automation amongst even Microsoft. It is the number one ranked. Keep your eye on it. It's freaking 10 billion. Microsoft's what, 3 trillion? So it's not going to go to 1 trillion. I'm not saying that. We need to head for like 50 billion. We need to do a 5x. I think it's possible. But the potential here is insane. It just started turning net margin positive. So they just turned positive when it comes to net margins. I'm telling you right now, this has some of the best emerging fundamentals in the market. Demand is picking up for UiPath's platform. It's called, go look it up. It's called Maestro. I mean, I don't know how to read that stuff. I'm asking a couple engineers to look into it, but Maestro is more advanced than the Microsoft platform. So this is my number one pick out of the entire stock market as of today, going into an agentic AI. And I say number one pick as in growth stock, higher risk growth. Obviously, there's safer picks that are going to go higher, like CRM, ServiceNow, but those are in the hundreds of billions in market cap. UiPath has a potential to get there, right? You have Snow also, but I don't think so. So UiPath is emerging. I'm going to do more on this later, probably a separate video, but UiPath is that stock. Okay, I've been looking at it for a couple of years. Now, these are by the dips. I think you got to go on the weekly here because there's an unlimited bid, right? The macro looks good. There's an unlimited bid for cybersecurity. This is one of those software plays that has to go higher. There's no choice because you need security on every front. The AI stack, the blockchain stack, the robotics stack, every single stack of technology needs cybersecurity. So who are the top players? Well, we already know. Hopefully this thing is getting crushed. Okta is something to look out for. I think Okta, from what I've heard, is a big player when it comes to this is identity. Okay, identity software. So whenever you log in and it does face ID, blah blah. So their identity software. Okta, I'm very bullish on. Okay, this one also looks good. I haven't looked into them enough though. This is Dynatrace is competing with Datadog for observability. Datadog disappointed me. It broke out, coming back down. But don't get me wrong, Datadog is number one for observability. This is another software security play who may be getting disrupted by where are they? CrowdStrike. CrowdStrike is the number one cybersecurity play for sure. Everybody knows that. But is it worth buying at these levels? Maybe for the long run, yes, it's going to survive. But if you're looking for a big, you want to see growth, CrowdStrike's not even profitable, by the way. They can get disrupted. They're just doing a lot of investing. Rubrik is a new emerging cybersecurity play. It's a smaller cap. What are we at? 2 billion? Oh, my bad. It's at 18 billion. Damn thing is huge. Fortinet. Now, this might be a dip buy. Fortinet is cybersecurity at the edges. So what do they call it? Routing, like plugging into networks. I don't know how to explain it, but Fortinet definitely is a big player. They're a leader in their space. I'm bullish on Fortinet. Okay. All right. That's it for cybersecurity software. Let's get into AI applications and then we're done. Actually, we got to talk, we definitely got to talk crypto because I think that's the biggest opportunity for me other than UiPath. Figma looks like it's coming back freshly. A lot of these software applications look great. Look at this these technicals look good. I just haven't looked deep enough. Pony, PGA, I don't know. This one looks good. Okay, a little more downside, and then we should be able to pick up. This one is special. Okay, this is AI, edge AI. Why do we need that? Because AI is going to eventually, a lot of these AI plays need to move the models away from cloud so they don't get disrupted by cyber threats and so that they're faster, there's faster throughput. If you have to connect to a cloud to do any kind of process, it takes more time. This is creating IoT, literally IoT as in internet at the edge. Wait, is that what they call it? IoT? Edge AI, edge computing, internet, something, I don't know, IoT. I thought that's what they made their ticker for. Anyway, they're creating the connectors. So I'm bullish on this stock. This stock looks good. The technicals look great too. This one could be special. Samsara is the name of it. It is, I think they're leading in edge AI. It's a 25 billion. This is going to be a $100 billion stock. So I think it's going to be around 200 pretty soon. Not soon, but next 5 years, 3 years, 2 years, could be 1 year. We don't know. Zoom has the best balance sheet for AI applications. The question is, do they have a product? Everyone's like, well, do you have a product? They have the best balance sheet, no debt. Zoom looks great. You want to invest in them. They're going to do something. They're going to create something. They have a lot of cash flow. Very bullish on Zoom, but the market is like, hey, well, are you going to do anything special, right? Can you create an application that works that people need that Microsoft can't just replicate? Okay, BBAI, great technicals. Everybody's super bullish on this government stuff. You just need it to break out. It's very risky. They're not profitable at all. Zoom is profitable. Yeah, this one needs to recover. This is a copycat for Palantir. C3AI is a Palantir copycat that is struggling a lot, but if they pull it together, it could have a lot of potential. Tempest AI, data analytics for healthcare. There's a lot of incumbents coming in, or this is the incumbent. It's losing momentum. It's on trend, but it's losing a little bit of momentum. There's a lot of innovation happening here. You might want to go in the daily chart. It's a little newer. It's trying to bounce. We definitely need it to hold this previous level around 66. I like it. I liked it better when it bounced. Now I'm like, double topping over here. We'll see. But Tempest say, I mean, whoever cracks the genomics thing is going to go stupid, right? Next is go to Adobe. I think Adobe is going to be fine. Adobe has so much cash. The balance sheet is really good. The growth is accelerating. Yes, they just had earnings. They're down so much. I think it's a good trade. I would say Adobe's a buy. Right? They're trending higher, gigantic. At least it trades into this big wedge pattern. At least it trades higher into that. All right. What do they do in after hours? We got to hear their new products. I don't know if they're releasing any new products. Probably do update inside of the chat. All right. So this is Sone AI. They're doing voice AI. This should be important pretty soon later. Who knows if somebody's copying it? I don't know. The other applications are all going to be finance. So these ones I think are going to start moving now. A lot of them are profitable. Upstart. This is a breakout. Okay. Upstart looks great. It's like Upstart, Lemonade, Affirm. Maybe it's Affirm I was talking about. My bad. Let's go to the weekly. Okay, here we go. So these ones are going to break out. You cut interest rates. You literally increase the margins on their business. Upstart, I'm bullish. Affirm, bullish. Buy now, pay later stuff, right? I know people are like, oh, they're going to collapse. Dude, there's just too much of it. You don't understand. Lending Club. These are all breaking out. Root Insurance looks like crap, but this thing could explode. We're looking at thing could double. I need to look deeper into it. I don't know what they're struggling with. Who's actually profitable though? I think Affirm might be profitable. I'm not sure. Lemonade. This is probably the number one. They're going full AI. They're supposed to be full AI. Almost no, they're not, well, of course they're going to be paying people, but they're almost going, this might be the first company. And they're also in a defensive industry. That's why it's so bullish. If the economy does slow, you still pay your insurance, right? So Lemonade Insurance is a special stock. You want to own it. You just want to own it for the next 10 years. The way things are moving, They almost have no overhead. They're going to like 10% overhead, so they don't really pay a lot of people. And a lot of businesses just can't do that and be profitable. PayPal looks like trash. I think SoFi is overbought. I've never been a big fan of SoFi, but SoFi is an AI company. You need to wait though. Dude, I don't know what's up with Block. They're Bitcoin crypto. They're, PayPal, same thing. They're struggling. They're just getting disrupted. A lot of these are getting disrupted. Hood, Monster, probably. I mean, that's my literally the. I look at Hood more than any other app in my life. Appfolio, we'll see. Figure is supposed to be good. This is AI solutions for lending, but there's not enough price action to really know. All right. Now let's get to the big movers. I want to say ASTS too. Oh my God, beautiful trend. This has the best trend in the market. It just moves so freaking fast, bro. So damn fast. I would like one more pullback like this. See how we broke higher, retested the highs, and came back? That would be nice. If we get one of those, I'm super bullish, right? This one you got to have. Why? They're competing with SpaceX. Not directly SpaceX, but not SpaceX. You guys know what I'm talking about. Elon's other company, Direct 5G. So if we get a rollover and consolidation, that's a wedge pattern for the ages because of how strong the narrative is. This is a telecommunications total addressable market's like 2 or 3 trillion. Verizon is merging with them. AT&T is merging with them. Why? Because they have something nobody else can do except for Starlink. There you go, Starlink. And people say, well, I'd rather just own Tesla and Starlink. Yeah, I agree. But it's not public, number one. Number two, by the time it IPOs, it's going to be $1 trillion company, where Space Mobile is a $25 billion company headed for $250 billion. This is a 10x opportunity if they can execute. They're not profitable. It is high risk, which is why it moves so much. Okay. But this has great technicals. There's a lot of traders in there. Okay. Lumen is, oh my God, I don't even want to talk about this. Lumen Technologies. They rebranded. They used to be an internet company, kind of like Cox Cable, and then they switched. I'm not gonna talk about that stock right now. Reddit. No, these are not what Netflix. Yeah, no, Netflix will be a buy the dip. I'm waiting for the weekly to really get. Once the weekly looks like this, I'm buying Netflix. Okay, Netflix ain't going nowhere. It's almost a win-win. A lot of people have to dump, but this is a win-win. The further it goes down, the better the value, in my view. All right. Now for crypto. Crypto is gonna come in the lead here. This is what I thought we would have, which is a retest. It's still possible, right? But now we have another Fed rate cut. We have acceleration. Crypto needs the ISM. Plain and simple. Here's what we need. Here's what we need. Other than the Clarity Act, U.S. business confidence, in the U.S. business confidence in the form of ISM manufacturing. Why is this important? Because the banks, okay, there was a couple of years ago, the top macro analyst on from JP Morgan, I forgot his name. I need to remember people's names. The top analyst said, if I had to look at one metric, if you took all the macro data away, and I had to look at one metric to understand where the economy is headed, or to understand where macro is going, because macro drives stocks at the end of the day, right? Interest rates, liquidity, where's the economy headed? If I had to look at one factor, it would be ISM new orders. ISM new orders is one of the key factors within this blue line. This blue line is an index for business confidence when it comes to 3 things that are important. It's more than 3. Number 1, new orders, meaning how many orders are supply chain managers looking to buy next month? Okay. Not today. This is a leading indicator, unlike the others. Now, the market's been up and it's been down, but I'm going to tell you why this is different why this is special for crypto versus people might say, well, how did the market keep going higher even though the ISM was down? Well, because it has its flaws. One of those flaws is it is a sentiment indicator. Therefore, it doesn't give you real production. It gives you how these supply chain managers are feeling. Let me cut to the chase here. The chase here is this. The reason why a macro analyst at JP Morgan, the biggest bank in the world, the most prominent, most profitable bank in history, said that he would look at ISM is simply because as soon as new orders turn positive, and right now we're negative, we're at 50, we're under 50, longest recession of all time. Okay. The reason their supply chain managers have negative sentiment is because of the tariffs. The tariffs have caused them to be, and they've jumped right up and down. The tariffs have them unsure. The one thing that gets them sure, because we had tariffs back in 2017, we had tariffs back here, 2018, 27, it was 2017, 18. We had tariffs back here. But the one thing that got these supply chain managers bullish was rate cuts. So once you get to a threshold where you get enough rate cuts, the ISM has no chance, has no way, has no other direction to go but up, because now the supply chain managers are like, hey, wow, we're increasing AI productivity and it's cheaper to do that. Now we can expand. Now we're going to order more parts, order more software. You don't really order software, but we're going to do more orders. So new orders is going to pick up. The other thing is employment, which is going to hold this down artificially, simply because the economy can grow without employment, necessarily exploding. Why? Because agentic AI is taking over, and it does seem ominous. There's going to be more jobs. There'll be different types of jobs, but we're in a transition period, and during that transition, job growth isn't going to look very good. I don't think it looks good till the end of 2026, after we have a huge correction, simply because we're in this big manufacturing transition. Trump needs to get manufacturing to the US. He's trying it. He's trying to get it there. But unfortunately, by the time we get more, job growth, there's going to be a bunch of robots doing these manufacturing jobs. So at the end of the day, new orders is very important. The other one is prices. Okay. Prices is part of this too. You don't want to see prices really spike, but they will start to turn up. So why does this retain to Bitcoin? Okay. Let me get to the point here. I freaking dragged on way too long. The point is this: Bitcoin is a risk asset. Crypto is a risk asset. Simply, it needs liquidity into markets. Banks look at ISM and they say, hey, look, if businesses expand, that means they're going to create more deposits into the economy because they're literally going to spend more. And if they spend more, if they expand those deposits into the banking sector, that gives them more fuel to lend or to borrow against. The more money you give a bank, it's like margin, the more margin they can take out, and they chase Bitcoin. Okay, because it's the scarce asset. It's more scarce than anything else. And when money and risk is, picking up, when the Fed is cutting interest rates, it's risk on, number one, especially at the beginning of the cycle. And you can see when the ISM peaks, Bitcoin peaks. So it has a correlation even here. Look at it, even correlates here. Like we can get the full correlation. Let me drag it down. Okay, let's see. So the ISM itself is literally, look at that. Look at Bitcoin peaked with the ISM, even though it didn't go to the all-time highs. It didn't go to the cycle highs, but it still peaked with the freaking ISM, bro. Okay. Again, peaks with the ISM. It's all liquidity. So it's down. But guess what? The Fed just cut interest rates. So we're going to see the ISM start to pick up. Also, you have global liquidity picking back up. Why? Because the Treasury General Account, which we talked about at the beginning of the stream, is going to start pouring money into the economy. They have about 900 billion to pour in. We're going to see a lot of M&A. We're going to see a lot of mergers. We're going to see a lot of, the biggest tax cut in history is happening, meaning January, February, March. You're going to get a huge impulse of more deposits. Literally, dude, the Treasury drained the banking sector, and then they're going to create tax cuts, which means bigger returns on your tax returns, which means more deposits injected in the bank, which means the banks have more liquidity to do what? To do more lending and to take more risk in markets. So the ISM probably ain't going to turn up till January, maybe even February. When it takes off, Bitcoin and crypto, I think it's already going to be rising, but that is going to be the super cycle that we see, and we're not there yet. Okay, so ISM is very important. It's the only shoe that hasn't really, risen. Everything else is bullish. Fed is cutting, ISM's going up, rates are coming down. But if I had to choose, okay, so looking at Bitcoin's technicals, Bitcoin looks great. Go ahead and take that off. Look at the technicals. I mean, it's pretty much bottomed out. It could drop. I could make another drop. Don't get me wrong. You never know. It could fall again. The daily says otherwise. The daily says we're expanding. So over the next, I want to say, week or so, Bitcoin has to perform, because That's going to tell you how investors feel versus these rate cuts. Are they bullish enough to really get long? And this is going to be institutions. Are institutions actually bullish, or do we retest the lows again at the end of December going into January and really flesh out everybody? Because everybody's going to say, you got rate cuts and we still rolled over. Oh my God. Here's the thing, bro. The Clarity Act won't pass till January, maybe even February. So I can see Bitcoin rolling over again and that weekly retesting the lows again, simply because you need more than just one catalyst. You need the ISM, which ain't going to be positive till January or February. You need the ISM up. Number two, you need more trade deals. Well, not for Bitcoin necessarily. You need the tax cut, but you need the Clarity Act. That is the most important regulatory thing. Okay. Once you get that, game over. Ethereum, ETHUSD. Did we test 3,200? Yes. We tested 3,200. BM&R finally went up. Okay. So Ethereum looks good too. The daily looks even better, just like Bitcoin. But this is what I want. This is my number one pick for the next 5 years. Okay. I don't see a better investment. And I've been saying this for years. And I've been, it performs and then it sells off. This is what you want to own if you're out there. Okay. If you're out there, you've never heard me. Chainlink is the number one opportunity in crypto by far. It is the number one opportunity in crypto. And maybe there's some AI stocks I'm missing. I don't know. I like UiPath, but this has the most potential by far. Okay. It's at 10 billion right now. Bro, I'm telling you, they're interconnected to every single bank. They are bringing a 0 to 1 technology, meaning, the way electricity was born, the way that autonomous vehicles are born, something that doesn't exist beforehand. They're bringing a verifiable web. They're bringing blockchains. And if you don't know what blockchains are, it doesn't seem bullish, which is why nobody's bullish on this. But in simple terms, what Chainlink is doing is creating a new layer of the internet. This new layer can be verified, okay? And it can be verified with zero knowledge. We're not there yet, but zero knowledge, as in you don't have to give up your data to verify. You don't have to tell people who you are, where you are. Governments don't have to give up identity. So you take away cybersecurity threats, because you're removing that identity factor. Okay, you're blocking that. Number two, you're connecting the entire financial system to blockchains, and it doesn't matter. It doesn't have to be crypto. It means BlackRock is tokenizing everything. They're turning every asset, commodity, gold, commodity, gold, US treasuries. They're all going on chain, guys. They're all going on chain. That is trillions that's hundreds of trillions of dollars of assets that must, move, just like they moved on the internet, are now moving to the blockchain internet. Guess who connects all these chains together? Chainlink. Okay. They have to pay in order for that service to run, just like you have to pay a Wi-Fi service, right? Everybody pays a Wi-Fi service. They have to pay the link service fee. Nobody else does this. There's not another company that has the same level of security than Chainlink. No one. Not Ethereum. Ethereum is not the true internet. It is the true platform for smart contract creation, right? But Chainlink actually connects those to a real world use case. Okay. They have proof of reserves where you prove something is true. This is a proof. We're moving into philosophically prove it. All this AI bullcrap, prove it. So Chainlink is bringing the verifiable web, which really unlocks, the Web3 ecosystem, the next generation of web services, I believe. And it's going to start in finance. It's going to be in supply chain management. And the bull case here is that, in order to tokenize all assets, you need compliance. You need, real world data feeds. You need security, right? You need to make sure that these are true. You need to make sure everything's connected. Well, to pay that updated software fee, you have to pay the Chainlink network. Guess what Chainlink's doing with all their tokens? You pay in tokens. You have to purchase those tokens. And Chainlink is buying back their own tokens. So they're already doing buybacks at such a young, small stage. They're buying back tokens. They're removing supply, creating scarcity. Their supply is capped, just like Bitcoin. Ethereum's is not. Ethereum has a mechanism to reduce, to create scarcity, but Chainlink, you can't create more, just like Bitcoin. On top of that, they're actually buying back. It's a company to buy back their own tokens. On top of that, the demand is insane. On top of that, we're still early. On top of that, the Fed is cutting interest rates and the interest rate cycle is early. On top of that, the Treasury is spending money on what? Crypto, is trying to move the entire financial system over to crypto. On top of that, AI is going to increase productivity and GDP tenfold. So there's going to be so much velocity of money on the internet, velocity of compute, velocity of messaging, right? Because AI agents have to speak to each other. Well, guess what? They have CCIP, which is a messaging service where banks and those banks can connect to each other and send messages. They're going to be using agents. So this is also an agentic platform for agents to confirm that something is true. All of AI is going to communicate autonomously to create businesses and functions and processes, right? Agentic AI, not general intelligence, not there yet. We're talking agentic, but in order for agents to do, to take over, to be automated, they need true verifiable data. That's what Chainlink brings. It's a play on big data. It's a play on big data analytics, not really analytics. It's a play on big data. It's a 0-to-1 technology. Stay bullish. Okay, stay bullish. My number one picks have always been Tesla, Ethereum, Bitcoin, Palantir, and Chainlink. That's never changed. Now I'm introducing UiPath. So I leave you guys with this. UiPath, Path and Chainlink. If I had to choose, I think, Enphase can make a big move. I think Fluence Energy can make a big move, but they're not 0-to-1. They're not really changed. This can make a big move too. Fluence. It's energy stack, right? You need energy. Nobody's looking here. It's going to explode. But UiPath, Chainlink. That's all I have to say. Bullish macro. The Fed is bullish. Don't listen to these fools on the internet that say, oh, we're going to a debt bubble. It's because they don't have exposure. And it's because they don't understand what's happening. Is because they just want to repeat what happened, in 2008 with ignorance, with straight ignorance. Not to say we can't have a correction. I think we have a correction in February, March, 10%, crypto 40%, right? I think we do see a correction here. We have to, and that's good because then you get the buying opportunity again. And the dip for those who missed out, they get excited. It brings in new buyers. Guess what? We're also heading into buyback season. So right now we're in buyback season. Listen, stocks are going higher. Stay bullish, stay blessed. Eat healthy, live as long as you can. Join the Discord. It's up there in the top link. I'll catch you guys later. Appreciate you. Thank you.